Welcome to the Back to Brick Property Podcast. I'm your host, David Lamb. On this podcast, we'll be stripping property investors and business people alike back to brick to find out how their journey can help you on your journey.
This podcast is brought to you by Orange Sales and Lettings. If you know someone that is looking to sell or let a home, please get in touch. Referral fees are available. Terms and conditions apply.
Welcome to the Back to Brick Property Podcast, sponsored by Orange Sales and Lettings. I'm your host, David Lamb. Today's guest is somebody who needs very little introduction in the UK property world, Adam Lawrence. Adam has been investing in property for more than 15 years and has built a property portfolio of over 600 units worth in excess of £60 million. Adam is also one of the UK's most respected property commentators. Today, we're going to find out just what it takes to get to that sort of level. Welcome, Adam.
Thank you for having me, David.
I think I got that right. The intro.
Pretty good, pretty good.
Did a bit of reading.
One of the best ones.
Oh, thank you, mate. Yeah, it's all downhill from here. But on this podcast, mate, we like to go back to brick, like I said, off camera, right back to the start, find out what makes you tick and how you got going, really. So, first question, what did life look like before property?
So, I only, like you said, 15 years, but I mean, I know I look young. Don't get me wrong. I know the people
just about to say that, actually. Yeah.
But I was still 32 when I got started, you know. So there was a fair bit of water under the bridge before all of that. So most of what I'd done before that, I've been entrepreneurial, including I ran a betting syndicate for a few years, which was not really betting. We used to trade bets. I used to tell people what to do. They got money on certain events, and then I would buy and sell them. A little bit like stock trading in a way, arbitrage trading, it's called. It was a bit easier way back then. And it was kind of, I'd had it as a hobby and it turned into something a bit more serious, but I knew it wasn't a long-term proposition really. But apart from that, I worked in wealth management for a couple of years. So I lived in Switzerland, in Geneva, between 2004 and 2006. That was pretty cool. But I kind of felt I'd hit my ceiling over there really and done what I was going to do. My second job over there, I was working for a family office. So you get to a certain level, and then if you're not one of the family, where are you going? Pretty much. Although it was great experience. I learned about diversification. I learned about wealthy mindsets. I studied what wealthy people did, and I learned about financial products and things like that because I had no clue before I did any of that. And then I did a year in one of the UK's top 10 lenders as like a cross-business consultant. So the department was called Customer Experience. But basically it was making sure going to bat for the customer when you go into a meeting and there's all these operational people going, well, we need to change that. And it's like, well, you know, Betty won't be able to log on to that, will she? Because she's 88 and you know Betty because she's the picture of the customer we have up in the office, right? But it, again, fascinating because I used to sit right by the compliance team, which was a weird mix in a way because compliance was getting in the way of stuff. But also the head of their mortgages was behind me. Right. Okay. So I learned an awful lot about that because they had like a bigger buy-to-let product and then their big residential mortgage arm sort of thing. Mm-hmm. But yeah, I learned a lot about how mortgages really work in HQ during that time. And that was sort of early days of, I'd just done a master's degree. I had a few properties. I'd had a few properties. I got no money left. I'd remortgaged my house. Used all the deposits, spent it quickly, like you do. It was good. I had cash flow, but I had no more capital. So I had to really learn.
That feeling,
and also I'd done this master's degree. So I was like, right, shall I put it to use doing that, or how's it all going to work? And then within about a year, I had a good opportunity come my way from a guy who wanted to do a joint venture. He said he'd inherited, or his wife had inherited £500,000. He was looking to invest it, and he was looking for someone who knew what they were doing in property. And I always say he couldn't find anyone, so then he came to me, you know. But so I was probably sort of half a dozen units in at that stage, and then we started a joint venture and kicked on from there. We bought a block of flats in South Yorkshire and kicked on from there. Really, not buying loads more blocks, which kind of some days I wish I had done, but I'm glad I've got quite a diversified portfolio these days.
Yeah, we'll get into that. Sounds like it. So it sounds like you're in a great environment then with your previous job. So just hearing those conversations, like you say, just being around wealthy people has a massive effect on your mindset, as we know. So, and then that first step into property, you did the JV, but you said you already had 6 properties of your own by then. So how did you get those first 6?
Yeah, so sort of going back. So my first, I had a property. I was very lucky. It was the old days where you could. We didn't even know what was going on, to be honest, at the time. I was working in a pub with my brother. I was 23, he was 18. We heard that a bloke wanted to sell a house down the road in the pub, and he was a mortgage broker. So he even said to us, if you buy it, I'll give you $5,000 off and I'll write the mortgage. So I don't know what sort of prop fee he was getting.
Direct to vendor for your first.
Exactly. Yeah. Little did we know. Yeah. So even though I was on £4 an hour and my brother was on £3.63, magically the Bank of Scotland lent us the money, and that was our first house. And I sold my share out of that when I went to Switzerland.
Right.
So I went to Switzerland with a little bit in the bank, and then came back with a bit more in the bank. Used that to buy a property. This was my big mistakes all in one go. So this was 2006 when I came back. New build. Top of the market. We paid the sticker price, and my now ex, we bought it together. We part exchanged her house. I'm not sure we could have made any more mistakes, to be honest, David, but it's good to get them out of the way.
It is.
Not that I haven't made any since then.
Early days, yeah.
But so we lived in that till 2008 when we split up, and then of course, you know what happened in 2008 by then, and we were like, oh, well, we can't sell it. We better rent it. So that was our first, that accidental landlord. Yeah. And then I went into rental, which was strategic at the time because I thought, well, prices are going down. Let's sit. Agreed a deal on one in May 2009. That was one to live in for me. And then got laughed out of the building society when I asked for a mortgage. Because my experience in mortgages then was the brokerage just sorted it out. Yeah. And I went in and they were just like, we're not lending to people like you at the moment. You're joking.
They weren't lending to anyone, were they?
No self-cert was good because my first mortgage was self-cert.
Of course, yeah.
And that was all gone. So I was like, right, what am I going to do? So I had some money in a business at the time and I managed to get some business finance, release that and do the cash purchase on the house, which then let me refinance that a few years later. So that's where my first deposit came from refinancing, pulling about 160 grand out. Yeah. But back in those days, in Midlands Way, Birmingham Way, you could split that into the deposit for about 6 properties. Because stuff was, I went to cheaper areas than I lived in. Stuff was trading at maybe you could buy at 80,000 and numbers like that. And you didn't need, and remember there was not even 3% stamp, let alone 5. So your frictional costs were nothing really. So deployed all that, like I said, generated a couple of grand a month's worth of cash flow, all good, but I was stuck with no capital left, as all good investors get to at some point. And then I really had to start, and that's why the JV came along at a good time, because I was like, someone's got capital. I've done a bit of doing now, I did all the stuff that you were sort of told to, pounded the ground, spoke to the agents, prospected for the deals, did a few deals that I was really, given that they were on the market, I'm actually still really pleased with to this day. And a couple that yielded, so I did a couple of HMOs. I remember doing the first HMO we converted, I think 2012 it was about 14 grand for the conversion. So numbers that just don't exist these days. That included putting an ensuite in.
Still ask for that price these days.
Per bedroom, if you're lucky.
If you're lucky. Even the Middlesbrough.
Exactly. So it all looked very, but then you didn't have your beautiful mustard cushions and all the rest of that. You know, if it was watertight and weathertight and clean, you were ahead of the game, you know. So that was my first foray into it. And then a few years, that ran well for a few years until then I noticed occupancy was starting to flag a bit and went and looked at what the competition was like. So it had always filled itself, like the tenants has kind of self-referred people. So we'd never had a void. And then suddenly we had a void. Then we had a second void. I was like, what's going on? Looked on Spare Room. I was like, blimey, competition's just blown this away. So at that point, it was that plus the jungle drums had just started to beat about the old individual single room banding for HMO. And I got myself very bearish about that and thought, this is going to come in across the board. This is because they're going to...
Yeah, there's a lot of talk about it at one point, wasn't there?
There was, and it was happening in a very arbitrary way. So like you're done and I'm not, and I'm across the road or vice versa. There's no fairness to it. And of course, since then, you know, the likes of Wendy Whittaker-Large have managed to appeal and get all that struck out, which brilliant job from them. But I was just convinced that the councils would see him as a cash cow and keep going after the money. So I thought, actually, I might move out of... because then they weren't doing the conversions for 12 grand anymore or whatever. And people were obviously spending big money on interior designers and things like that. And I just thought, they're only getting the same rent as I've been getting for 4 years. So there's no premium here. It's just competition coming in. And that's when I realised, again, before the days of Article 4, certainly where I was operating at the time, there's no barrier to entry. Someone can buy a house, chop it up, and they can put tenants in, and there's another rate. And who knows... I've spoke to people over the years, and one of the questions I've asked people who've created a lot of HMOs is, how big's the demand in your town for HMO? And nobody ever knows the answer.
No, they're winging it a lot of the time.
And they believe in their product. And the thing is, when your product's brand new and it's lovely and shiny, you will fill it, and you'll fill it at premium rents. Wait till it's 2 years old.
Exactly, it's been knocked about by the tenants because it's obviously the high turnover of tenants, etc. A lot of footfall through the houses.
Yeah.
Then, like you say, that the competition's got even better and better within that 2 year period again.
Exactly.
And then before you know it, your HMO, which looked beautiful on day one, is sort of out of date. Almost.
Someone's got a cinema room or something crazy like that. You know, you're like,
that's the way it's going now. The standard of HMOs is incredible.
And again, I saw that coming because that was already happening in the student market, and I was looking at some of the purpose-built stuff that was being put up in places, and at the time, I didn't really understand how they were getting the rents they were getting, but of course, it was just international students, and you don't really realise until you see what a cohort of students looks like. You're getting people from what we might consider to be like poorer countries, but it's the top 1% of families who are sending their kids over to the UK. So they've got loads of money.
Yeah.
So £250 a week for luxury, for Tiddles or whatever their name is. Yeah. Of course, they're going to pay it. They're going to pay it. So they've got the money. So that kind of, I didn't understand that market very well. So I thought, I'm going to get out of it. And I leased one to a social provider, and I sold the other one because I had two at the time, and then thought, right, no more HMO. It hasn't quite worked out like that, but. And I wish I hadn't sold the one I did sell, to be honest, but you live and learn, and it's good to get. I've got a few more sales under the belt these days, but we'll talk about that later on. But
so there's a lot to unpick there, but I guess you did a JV very early.
Yeah.
How did that go? What were did you have any sort of anxiety around going into a partnership with somebody so early in your journey? A lot of people do JVs, but it's a lot further down the line, if you like.
Yeah. Well, one of the things that was really helpful to me actually was so I was probably about 2 years into that. And a chap sat me down, consultant I met at a networking meeting, and he just talked through it. He was trying to get my business, obviously. But he said, so how many partners we got? So I've got this one guy. He says, what happens if he gets divorced, loses interest, goes under a bus? And I thought, blimey, that's a good point, that is, I hadn't really thought about that. So I thought, right, well, what could I do? Well, he can be insured, of course. Or I could maybe have some other partners that I could consider working with, because I quite like this JV model, because it's enabling me to do much more than I could on my own. So I always had this idea that I wanted or needed to get to this critical mass so that I could get some help with management of properties, so that I could, the more you've got, the more that comes to you. That is, and that has absolutely been the way of the world for me, So that bit worked really well. The first project actually was a block of flats. It went badly, but it was good in a way that it went badly, because it was a repo. It was a bit of a classic. Planning in 06, funded in 07, built 07, 08, repossessed in 10, and we bought it in 14, I think it was. Started its life on the market, about 900 grand they wanted, which must have been what they owed. Yeah. We ended up buying it for 462. And we got RICS of 600 to 650 before we bought it. So I was really well organised with de-risking it. Yeah. But luckily, I also had the presence of mind to say to him, because I was quite active on Facebook, and that was the property chat of choice at the time. The Facebook groups used to be really, really rich and really good, whereas these days they're a bit, Facebook's got 80 things going on, so you just lose it all in the noise, and they've started monetizing it also. If you don't pay, you don't see anything, But I'd managed these expectations that we might somehow get screwed on the refinance, right? And he was like, well, we've got this RICS. And I was like, look, I don't know what more we can do. And we didn't do a lot. And that's always a problem, as you know, the lenders don't like it, because it was still nearly brand new. We spent 10 grand, most of which was on landscaping, bit of CCTV, just put a nice little cherry on top of it. But a couple of flats needed a dust up, that was all. And, there was demand, and it was a good one, because it wasn't vacant, but it was so it's 10 flats and 2 shops. So it's a lot for 462. Yeah. Like I said, a little village called Conisbrough. It's in between Doncaster and Rotherham. Right. It's got a castle, right? And it's not an area where you'd expect there to be 1 or 2 bed flats. It's much more terraced houses near the centre. And then, like it is in slightly more, it's not semi-rural South Yorkshire, I suppose, you've got a little drive to the next village, or Donny is 4 or 5 miles away. Yeah. Rotherham's 4 or 5 miles away the other direction, sort of thing.
A decent sort of.
Well, it's a nice enough village. Demographic. I walk the streets. Thought it looks okay. There's employment. There's stuff going on. Say village population about 14,000, so it's not not a small village, big village, but nice in it. So I didn't see anything I didn't really like about it. There was one tenant in one of the shops and one empty shop, and there was 2 of the flats that were. So the receivers had encouraged people to go, as they do, but there was these 2 guys who clearly, and they were both older tenant profile, and they didn't look like they wanted to go. And they were all right. So didn't see it, but they're still there today. Both of them are still there today. So 2014, so 12 years down the road, they're still there. So that was, but because it wasn't empty, someone who wants an empty building, it's not attractive to them because you're going to have to do an eviction or whatever. These days, that would be more difficult, as I'm sure we might touch on later on.
I do, yeah.
And someone who wants someone who wants to sit in London and buy a fully tenanted, ready to go block and knows what rent they're getting, that's also not attractive to them. Yeah. It also, especially at the time, because financing wasn't what it is today, because it was still struggling with what happened in the crash and all the rest of it, it wasn't the easiest to finance, right? Because what are you getting a commercial value? Well, you can't because the rent roll's not there. Yeah. What are you doing with the downstairs? But again, much more savvy these days around title splitting and things like that you might do to make the product better. But it just seemed to fall into the cracks. And I was like, and buildings like that over the years have worked well for me, where what does the buyer look like? It's not an armchair and it's not someone who wants something blank canvas. There's a bit of effort and a bit of grime and a bit of who knows how long that's going to take. What if those two tenants are problematic? Because you know what the receivers are like. I mean, getting inquiries answered by them was the hardest thing in the world. But we got a reval on it, and it was revalued even after we'd done the works. It looked great, 500k, and the bank had clearly, again, wasn't savvy enough at the time to really know what had gone on. I kicked off to high heaven. They did an internal audit. What was that worth? Nothing, really.
Did it take no notice of your RICS of your previous?
So I showed it to them and said, how can this be? This is an insured valuation. And they said, well, and basically it was what it had traded at. That's what they didn't like. They didn't like the idea of letting us have our money back out. So investors stuck with maybe about 120, 130k of his original money left in. Now, I'd already pre-agreed with him what would happen if that happened, because that's what I always go into something saying, right, I know where the downsides are. I'm not putting us off from doing it, but what if this? Yeah. Then this is what we're going to do. So we followed the plan, which was he would get paid back monthly. He was happy enough because we invested some of that 350. Then we bought some more stuff around and about there. And then he did lose interest a little bit and/or started. He wasn't working at the time either, so he was spending his money as well. He wasn't bringing in income apart from the property income. And I think we'd already brought in enough property income. As far as he saw it, he was like, well, I haven't got a mortgage on my home. Could probably get by on that property income, spend the rest and have a bit of a good time going to the USA and doing this and that and the other. So I was like, when that consultant's advice came in, I thought, yeah, I'm a bit dependent on him here. So I need to start looking for some, and then also start thinking about what can I get out of partnerships in terms of, because what can I add? What can I do? What value can I add? But what do I need from a part? Do I need a builder, deliverer sort of partner? Yeah. Do I need a partner who can get deals? And I've worked with all sorts of those sorts of people over the years. Yeah, and that's been good. And 80% have worked out pretty well. And even the ones that haven't worked out that well, we largely managed to sort of cut our losses or at least shake hands on the way out. And the winners have been worth reinvesting the time and effort and money into. And they've gone much bigger, and the slower ones, and some of them, like that one, still got that block of flats today. Right. I don't know what it's worth today, 850 maybe a push $1 million, I don't know. Rent roll's gone from, what was it when we bought it? I think it has ERV of about 48 or something like that. It's now getting about 70, Brilliant. I think. So it's moved, it's done what properties, and it's still, at the end of the day, it was a new build block, and it was well built. Yeah. It was just not structured in the finest possible way, so the guy had got it and had it swiped. Yeah. And he obviously was over leveraged because as soon as the values came down, I mean, there were flats the only other flats in Conisbrough were 2 beds at the other end, which were done maybe a conversion of a NatWest bank or in a car park or something like that. I can't remember, but they'd sold in 2007 140 grand for a 2-bed flat. Yeah. Well, I think today you could still go to Conisbrough and buy a 2-bed house for 140 grand that was in good nick. So they were made up prices, and whether they were real, who knows? Because a lot of stuff,
world, wasn't it? It was a
lot of stuff went on. Yeah, gifted deposits and the blah blah blah, and valuers saying things were worth what they weren't, and all the rest of it. So, but still, those. Imagine my comparables when thinking we're buying 10 flats and 2 shops for 462, and the only sold comparables were, and I knew it was too high, but I was still like 2-bed flats, 140 grand. This is, but it's, and of course I didn't really understand commercial valuations back then either. So, and it was a different way of it being structured. But we've done that's been a great example of a property. We bought it well. When we got our second refinance, and actually we didn't wait the 5 years. It was one of the first times where I broke a mortgage and did the early repayment because 2014, mixed use, very few lenders in the market. We were paying 6.5. Right. Now, obviously the rates kept coming down and we got into a position where there was a lender who at the time came out, who was a new lender, who was hungry for business, and they quoted us 2.98. And I was like, well, saving 3.5% a year, so it's worth breaking. Yeah. And then, we've done various bits with that over the years and refi, and now we just got it on a relatively low loan to value. So that's one of those assets, companies that just sort of sits there, ticks over in the background. We take an income from it, and it's just being asset managed along nicely in the background, and it's doing what we're all told. Yeah. Time's your friend in those situations.
100%. 100%.
And it's been a textbook, really.
Without a doubt. Just scaling back a little bit, Adam, there. So with your background in sort of wealth management and the conversations you were around, why was it property? Why did you choose property over other asset classes?
So it was interesting because one thing when I worked in wealth management that both the firms I worked for were absolutely religious about was no property.
Right, I'd imagine, yeah.
And I find that strange. I mean, so a lot of IFAs still say that, but you've got REITs and things like that where you can access property and you can buy, quite often at a bit of a discount to the asset value. So if you want armchair property, the difficulty is it's normally commercial. So you've got to understand you're taking a bit of a punt on where the interest rate goes. There are other things that you need to think about, but they're very flexible. But that always interested me. And I genuinely used to love Monopoly. We played far too much Monopoly when I was a kid, but it was just really obvious to me, even though my experience was we'd bought this house in 2006, value had dropped, but you remember the rental market was really strong. The rental market was strong and rents were moving upwards and it just seemed to be growing and growing and growing. I thought, well, rents are strong, so yields were good. And bear in mind, at this point, the base rate was down to 0.5%, but you could get your 7% plus yields on property. And I thought, well, and you were borrowing probably about 4.5, and that then dropped obviously throughout the whole decade to like 3. But I thought, look at it over, and I did all the work. The gurus, like this, still some of them even say today, it doubles every 10 years. I mean, it doesn't, does it? But
not in the Northeast.
But there are periods where it has doubled.
Yeah.
In less than 10 years, actually.
For sure.
But I was looking at it thinking, well, the yields are creeping upwards. How do the rents move? Because that's what I was interested in. Well, they seem to move at least with inflation, depending on what sort of product you're offering. If you offered and my target was always sort of try and be in the top quarter of the local market. And with respect to some of the places I've invested in, sometimes that means cleaning it up and presenting it nicely. If you're doing that in Mayfair, you need, gold taps and Corian and whatever else you might need to make it pop a little bit. But that was, it was, I could control it. The prices were good. So my target in 2012, when I was going out pounding the ground with the shoe leather, was buy at 2004 prices. Right. Just used it as a fairly simple yardstick. And I was able to do that. I was buying stuff
throughout the country.
And I was broadly operating in the, I don't think I went more than an hour from home. Right. So just in the maybe 45 minutes from home. So where I live specifically, the yields are quite low, so you couldn't make it work on a single. You'd have had to do, and I'd have had to put I wouldn't have bought 6 assets. I'd have put all my capital into 1 or 2. So that didn't make sense either. I wanted the diversification, even though it was more work, but it just looked like a no-brainer. The values had adjusted. The crash was bad, but it wasn't as bad. Unemployment wasn't so bad. We were recovering. The economy was growing again. People's incomes were growing, that they were going to be able to pay their rent, and people were having to rent because of the situation. They couldn't get financing, same way I struggled. So you saw a huge number of people who wanted to rent, and I thought, well, I didn't see the population going down. I didn't really have too much of a position on migration, and didn't sort of see all what happened coming necessarily. But it was obvious that population that would rent was growing because more younger people were getting older and coming into the rental market, sort of thing. So it wasn't really a reason not to, apart from the effort. And I just I learned so much in the first refurb I did. I went and did a 1-week intensive plastering course.
I did that, yeah.
And I'm terrible. I can't wire a plug. Do you know what I mean?
Same, yeah.
Rubbish with stuff like that. But it taught me a lot about plastering. It taught me a fair bit about tradies and mentality and managing projects and stuff like that. and I'm really glad that I did it. You know, never plastered a house again. I'm saying that.
I did exactly the same. Yeah, I did a couple of flips and I plastered them. It was horrendous. My decorator must have hated me, but yeah, I thoroughly enjoyed the course. By the end of the 4 days, I thought I could plaster. I had a 2-week break before I'd actually did some. And I'd lost everything.
Yeah. It's hard work as well, isn't it?
Bloody hard work. Work. I don't envy those lads.
No. So, no wonder they're big.
No, yeah, exactly. So was there a point in your journey when you like a defining moment when you thought, do you know what, property could be my thing? It could be the way I'm going to get wealthy.
Well, I think the simplicity of I was able to remortgage out my house, so that gave me a bit of an edge, didn't it? That not everybody has that capital to start with, and then I did the money where we got to quite quickly within about a year was there's money on paper. Well done. You can't eat it, right? You can't eat it, and you couldn't access it. I was already leveraged to 75% or whatever. I've had what I can out of my house. Here's the money coming in, but the money's there's not as much cash flow, especially compared to what I've got on paper. So at the time, it wasn't really a market for flipping. In one of those 6 was a failed flip that we had to rent in the end, which again held on. I think the numbers look like something like we couldn't sell it at about 240, and then about 5 or 6 years later, we sold it for 300. So it wasn't a disaster, but it wasn't. It never looked like a proper rental in from a yield perspective or anything like that. But it was the proof of concept was there. We'd done 2 of them, got all the money back out. So full, one of them 28% below, one of them like 26% below. And then the others, generally speaking, got most or nearly all of the money back out. So I was like, well, proof of concept's there. It was the flip that sucked up the capital. And at the time I didn't think, right, bridge against that, further advance, all the sort of things you'd have thought these days. I was just like, I'm a bit stuck with that one, really. We got a load of money stuck in it. So that's what probably put the kibosh on it. And that was the difficulty of seeing like multiple exits. If you don't have them, you're better off when you control your own exit in many ways. So so that's when it really sort of ingrained into me, buy to hold, and then never sell, because it was a bad experience trying to sell that. The market wasn't doing what I wanted. Why would you ever sell one? Because it's hard work. And then things had changed over time as the market's changed.
People forget that. People miss that, is that the key to retaining property, I mean, in my eyes, holding property long term is the key. That's where you really win big. But just controlling your exit, just the control you have over that exit on the refinance, whereas like you say, you might see a big profit in a flip, but ultimately you don't know whether that's actually going to work out or not.
Yeah, exactly.
This podcast is brought to you by Orange Sales and Lettings. If you know someone that is looking to sell or let a home, please get in touch. Referral fees are available. Terms and conditions apply.
So from the start, it sounds like you were quite knowledgeable from the start. You were looking at yield solely. By the sounds of it.
Yeah.
You were BRR.
Demographics. A little bit of what investment in the area and things like that, but not massively scientific.
Yeah. So the BRR model, you were obviously exercising very, very early.
I don't think it was even called BRR.
I was going to say before it was cool. Yeah. So where did you learn that? Was that just something you'd heard from the mortgage guy you were sat with? Or
I remember I went to a few. So in 2011, I decided I wanted to give it a go, and went to a few networking meetings. So I left the credit card at home sort of job.
Good. Yeah.
But one of the things that I did do, because I'm pretty impatient, I'm an entrepreneur at the end of the day, so I want to get on with stuff. But I thought, right, 6 months learning, meet some people on the circuit, see where it all goes. And it was, I read a copy of Simon Zucchi's Property Magic, and I thought, that sounds easy, doesn't it? And all the typical sort of like, you can't do that. Who would sell their house below market value? I didn't understand why deals would come about or anything like that. And I saw Simon talking the other day, and he was still talking about motivated sellers 15 years on. But the foundations of the book, I was like, well, let's see if it. And one of the things it recommended was going and meeting the agents, doing the shoe leather thing and stuff like that. So I just did what it said in the book. I didn't do any training with Simon or anything like that. I just thought, right, get on with it. Yeah. Start working, find the areas. Some of finding the areas was about where companies have started putting infrastructure investment in, or big new retail parks, things like that were going on. I was like, well, that's a bit of a no-brainer. It's well located near a motorway. There's more expensive areas around it, sort of thing. This is the cheaper bit. So it's where the starter homes will be. It all sort of fell into place and made sense to me. And then because the 25% below was the yardstick of success. And I think the book probably made out like it was a little bit easier to get than it was, if I'm honest. Yeah. But I did do a couple, 2 out of those 6 were, and I'm really pleased with that for sort of first deals, And then the other ones, it's kind of like, well, either you're getting a good yield or you're going to have to wait over time in order to, so second refinance will sort of sort it out. I wasn't sort of in a breakneck speed kind of, I did a lot very quickly and was learning multiple things because one was an old illegally converted into 2 flats. 2 we made into HMO. 1 was a failed flip. And then the other 2 were just singles. Yeah. So bit of everything all at once, really, which is a lot to take on because we were doing 2 or 3 projects at a time at one point during all of that. But it was pretty clear that once you were out of capital, you were going to be in trouble. Yeah. And then that's exactly what happened because that flip failed. And I was like, plan B. What is plan B? Hadn't thought of plan B that, well, I have to rent it now. I think it rented for about $1,000 a month. So even in the days of cheap money, we thought it was worth 240, 1,200 quid, 5%. Yeah, 12 grand a year. That's 5% gross. Yeah. Just wasn't enough, was it? Right. That was the thing. But the market did have to get better. And then it was the old, probably suffered a bit on that one in the end from, well, the tenants are in now and they're paying. Yeah. So just let the tenancy organically go rather than think we've got to take control of that and reposition the money and all the rest of it.
I think probably quite forgiving in general, isn't it?
It was there very much. And it was the old, that was a bungalow. Bungalows in that specific area, like in a lot of areas, are in short supply. Mm-hmm. So it's always going to hold its value. Yep. It's always going to be desirable. And you probably sell it to a downsizer, like we did in the end, who's a cash buyer. Mm-hmm. And you get, all the bungalows like that we've ever sold, we've got asking or close to asking or above asking. Yeah.
Mm-hmm. So how does the portfolio look today then, as we sit here today? What's the sort of mix?
So, and so as you said in the intro, numbering about 600. Of those units, around about 70 odd are commercial. So that's either parts of shops and tops or part of a commercial site, larger commercial site that we own. I've got 1 pub in there as well. That's commercial. And then the resi is split into lease to providers, which I've been doing, I've been doing for about 12 years. Vanilla sort of single let stuff. And a very small handful of HMO. Mm-hmm. So most of the HMO we've got is HMO lease to provider sort of stock. So, and within that, different providers, different tenant types and needs that they're catering for, different geographies. So there's not a lot of, it's very deliberately not got a lot of dependency. Mm-hmm. Geographically, it's spread far and wide. So it doesn't look like a lot of portfolios. But then obviously when it gets a bit bigger, you do struggle to be in one specific area, but you're also, I think, you're loading a lot of risk onto local employees. If you wanted, classic example would be Sunderland, wouldn't it? Build a portfolio in Sunderland. I spoke to a guy once actually who, in a networking meeting near me, who had all his properties, 30 properties in Leamington Spa. Right. Leamington's lovely, right? Good. So in my head, I'm immediately thinking, well, they won't yield very much, but there we go. And then he said, all the tenants work for Jaguar Land Rover. And my face just fell. And he goes, what's that for? And I said, well, what if Jaguar Land Rover get in trouble? Have you got put options on the share price? I mean, what would happen if they all got laid off suddenly your cash flow is destroyed? And he looked at me thinking, bloody, I never thought of that before. So sometimes replicating increases dependency, whereas I've been, and again, that's a bit of a wealth management, probably the number 1 word in wealth management, diversification, like that you're teaching your clients. So diversify by geography, diversify by tenant type, and ultimately diversify by use class to an extent as well. So we've done all of that. That is strategically deliberate, but also probably 90-10, 85-15, been deal driven rather than location driven. Mm-hmm. There's been times...
It's probably the way it should be.
Look, being geographically agnostic, as I call it, it has its pluses and minuses, right? You're going to pay out a town tax unless you're working with some really good people. Yeah. So that's got to be priced into your deals, right? There are certainly times when I've targeted areas. South Wales would be a great example after Brexit. Bristol was going absolutely gangbusters. It was very difficult to buy around Bristol. Mm-hmm. But, Southeast Wales, so close to Bristol, 20 minutes on the train, places like Newport. Yeah. I knew the toll was coming off the bridge. It was like the stars had aligned. And I was like, the difference between a 3-bed semi in Newport at the time was worth 130, and West Bristol it was 300 grand. And I was like, well, that's not going to hold. That geography will not going to be the same price, but geography will arbitrage that, because people aren't stupid and they're going to look and go, well, hang on. Yeah. If I did and the thing is, if you live in East Bristol, it'd take you as long to get. If you worked in West Bristol, it'd take you as long to get there as it would from Newport anyway. So there's nothing really holding people back. So I thought, well, this will blow up. This will, and sure enough, within about 2 years, the 3 beds in Newport were 180. Yeah. So it worked really well, but we didn't get as many. The narrower the area you go, and I know some people say I invest within 5 miles of where I live, or in London, like 1 mile radius of where I live, and there's a lot of rooftops there. But you are going to limit the deal. Even if you get every single deal that ever happens in that radius, how good is it going to be, and what's the trade-off? Whereas if the model, if the deals are good enough, if the discounts are deep enough, you can get away with the out-of-town tax. You can get away with the sourcing fees you might need to pay. You can get away with all of that. And you get that deliberate diversification. So you're never going to get your legs cut off because Serco give notice on all their asylum HMOs, because Reformer got elected and said no more asylum HMOs. Yeah. It's not going to happen. It's going to hurt a little bit, but not to the tune where it'll be a wobble. It won't be
absorb it.
Yeah.
So most of your stock, would it be fair to say, is on social leases then? Are these blocks? Are these like blocks of apartments?
Yeah, so it's not most. It's more like about 30% of the income.
Right.
I'd like it to be more like 40, but it takes time to shift things like that with a portfolio of our size, as you know. Blocks, we've got a few. Biggest block is 25 units. Got quite a few small blocks, so anything from the 2s, 3s, 4s, 5s, 6s, 7s. Got that 10 in Conisbrough that I talked about. Not much in between. I once had a block of 18 and then sold it. But those are most of those are, some of the smaller ones are provider, but the bigger ones are either a blended mix or private AST, because the collar rents have moved that far in a lot of these places where we're delivering a nice product in somewhere, say North East Links, and the rent would be $650. And we're the best flats in the town, if I do say so myself. But again, it's not taking. It doesn't mean it's marble everywhere. Do you know what I mean?
No, it doesn't need to be.
Best flats, come to the best flats in the town, top quality, and people can pay the $650 because people who are on minimum wage or people who are on, it's all been pushed up so far by inflation. They're not struggling to pay that rent every month, and they're quite stable tenants, stay for quite a while, and so the yields are, really strong, like 15% plus gross. So obviously you've got your op costs and things like that, but still you're starting from a really good place with stuff like that. So, and then a fair few are houses so either houses done as single lets to the provider or minimos generally, 4-bed minimos.
To the provider.
Sometimes, sometimes 3 up, 2 down. The back room's the lounge. The front room's a bedroom. So 1 bedroom downstairs. So they can give you a 4-bed equivalent rate, or depending on how they work their numbers out.
So what is it that appeals to you most about those providers? Is it the hands-off nature of it? Is it?
Yeah, I think the credit risk has been the thing really that's driven me since COVID, because one of the first things we did during COVID was, right, what does a portfolio look like if everyone loses their job and everyone's on housing benefit? Was one of the first bits of work we did. Are we bankrupt? Are we cash flow negative? Where does it leave us? And we were still making money if that happened. So I was like, well, that feels like the worst case. This is before furlough and the shotguns came out and they started firing cannons of money everywhere. But I was like, right, okay, so I'm comfortable with that. And then we started looking, and it was when we bought the year we bought a big portfolio in Scotland that was about 50% housing benefit, which historically we would have thought like, I don't know. But then we were like, hold on, the government's underwriting this. This is actually a really strong covenant at the moment. We want this. And then thought, right, how else can we get the government to underwrite? Because the councils don't do much direct leasing themselves, as you know, it's pretty rare. Well, we need to work more with these housing providers. So the credit risk side, and of course the credit risk side, that bit's got worse since renters' rights. Of course it has. I don't think it's terrible if it's managed well. And I think you're now going to see a lot more money orders, money claims going against bad tenants who are going to be forced out on Section 8 because 21's not there anymore. That'll be the advice. That'll be the way to go. So that'll then, well, will it clean itself up? I don't know, because I haven't quite moderated in my head yet. The statutory duty to house doesn't apply if they're not vulnerable or they haven't got kids now, because they'll be voluntarily homeless because they voluntarily haven't paid their rent. And this is one of the renters' rights things that no one in Westminster understands that argument.
A few of those points, I think.
There are a few, and they'll come out. We know they'll come out. We know they will. So that was the driver. Really, was more the credit risk, the no hassle. Look, some providers are hassle, right? And you've got to keep an eye on them because it might be full repair and insure, right? Do you want to get into a delapse battle with one of them at the end of a lease? How good was your schedule of condition? It becomes a commercial property transaction.
Of course it does.
And the thing is, when the delapse are 150 grand, you can afford a delapse surveyor and this, that, and the other, and a litigator and stuff like that. Even though I don't like spending my time on this, I find that a very negative activity. I'd rather try and make money by adding value than trying to fight for my bit of value I should legally be getting. Although if I've got to do it, I'll do it. But you don't. Do you want that argument over? What might be 10 grand's worth of work at the end of a lease with a provider you'd still rather have a relationship with, probably, because you've probably got other properties with them or you want to put more properties with them. Yeah. So sometimes you've got to give them a bit of a hard time, but you got to inspect them and snag them pretty hard. And sometimes they're not all on full repair, are they? Some of them are on fair wear and tear, or, you do the structure, you do the boiler, you do this and that. Then is it an argument about, well, the boiler's been misused because it's been overpressurized and all that sort of stuff. So it's not no work, is it? But they are. Look, the void risk, I think the void is the enemy of the landlord.
100%.
And the void risk has gone up again. RRA has put that up with this stupid 2-month rule for the notice for the tenants.
Yeah, I don't know how that's going to work.
Badly. I'm already seeing it play out badly. So people are being told, and I'm in groups of portfolio landlords where they're saying, well, I've just had someone want to move in July. And it's like, well, the thing is, you're going to end up charging tenants half rent to bridge the gap for the month. But this is a bad time for the tenant. They haven't got a lot of money. That's why they're renting at the end of the day. So are they going to find an extra? They probably need money to move, right? If it's a few £100, the deposit's tied up, as you know. It's really problematic. So you've told them that the message you've sold is, look at Valhalla over here and you're free now to do this. But you're not free, are you? Because the landlord is going to take someone who can move quicker, or they're going to push you into signing up earlier than you otherwise were. Well, you're going to pay double rent for 6 weeks to get a property. Because where supply starts to shrink on a micro level nationwide in certain places, especially where the yields are low at the moment, this is exactly what will be happening. This great victory for the students who are giving in their notice on the 1st of May this year won't be a great victory in 2 years' time when there's no bloody student HMOs, will it? Because they've been repurposed or whatever.
It's short-term thinking, isn't it? It's just like you said. I don't think the people in the government understand what's actually going to come out the other end of this.
Of course they don't.
But we'll get into that. I want to ask you, Adam, what do you think is the key to scaling quickly?
Yeah, and I'm a big advocate, and I think it's hard to do, but this is ultimately what I say to anybody that I work with on this basis. You want to scale quickly and safely, and those two feel like they're in fighting against each other, but they don't have to. So, I mean, one of the things you can do is look at properties that have got existing streams of income already coming in. So the first time I ever did a bridge, I never used a bridge for, I'm going to say 40 transactions, to be about right. And my first bridge, I was so worried about bridging, so nervous, so scared of bridging, genuinely scared of it, that I bought it because even on the bridge, it cash flowed. Right. And that got that mental block out of the way for me. So you can buy, there's plenty of stuff that trade, and especially at the moment when the yields are elevated, buy something that's cash flowing already. You're still going to need an angle unless you're just buying it super cheap. It does happen, right? But how are you going to asset manage that? How are you going to add value? Are you doing it because you've got a bit of land with it? Are you doing it? There are multiple ways to skin that cat. But that's what helped me in my head get past that side of things. So bridging, the other side of it that helped a lot with me was, so I think definitely number one needs to be you really take the time to understand bridging, because instead of the old 25% deposit and that way round, I started getting stuff with 15% deposits, then 10% deposits, then 0% deposits. And it's like, obviously you can scale infinitely with that stuff and I always explain this by using this framework that I came up with about 10 years ago. If you're going to do this and you're going to be good at it, you're going to have success, there are four areas you're going to need to consider. Deals, where'd you get them from? Where's your supply of deals, right? Ideally, it needs to be abundant. yeah? Or you need to work with people who've got an abundant stream of deals, yeah? So you need to understand them. You need to do what you said you were going to do. You don't need to buy every single one. Don't worry, it's not as... You want the conveyor belt to have a lot of stuff on it so you can pick off what you want, right? Then you got to finance it. So your financial structure's got to be good. That might involve JV. It might involve angel money. It might involve 100% bridging. It might involve something else. It might involve your own cash, remortgage your own house, whatever you've got, cash flow from other businesses, whatever. Then ultimately you've got to do. You've got to operationalize that, right? You've got to make that the best it can be before you present it to a valuer for a term finance loan. Yeah. And then ultimately you've got to manage it. You've got to manage that asset. So not just the property management, letting side of things, manage it as a proper asset. So is it one of those where you bought it, it's tenanted, actually we could get a provider in there, but we're not going to chuck the tenant out, right? But we are going to manage the rent upwards. We're going to show them a multi-year plan for how the rent's going to be managed. So we don't just go in and go, right, well, you're paying 500 quid, but it's £1,000 these days. So straight to 1,000. Apart from anything else, even if I've never done that because I don't think it's ethical apart from anything else, but under the new challenge system, I don't think you're going to be able to do that anyway.
No chance. No.
And 90% of people can't afford that. So are you going to evict by the back door in that way? Again, I don't have to make my money doing that. So it's not I'm not an asset stripper. I don't do things like that. So that's not for me. But there will be a multi-year plan so the tenant can then understand, well, this is where I'm going to need to be. And I mean, I would say this, we're not in the landlord's seat, but I think really a lot of them should look at it and think, blimey, I've saved a lot of money over the years. Yeah. And they will have known at some point their rent was a bit cheap if they've got, we have had the odd one when they get a rent rise to say, well, I'm giving my notice in. Okay, understand. Yeah. Then they go and look at Rightmove.
See it all the time.
Then they come back and rescind. And, very, very few of ours have ever had a rent increase notice and then gone. And the ones that have, we've probably wanted them to go, David, if I'm honest with you, because there is, and that the eviction via rent squeeze, well, Labour have created the grounds for that. Not that the Conservatives didn't freeze LHA, because they did. No, they froze it to death, right? So I'm not being deliberately political there, but their ideological standpoint against local housing allowance means that people will be forced out of properties because you're layering. We just wait till we've got to do the infamous landlord register or whatever. Yeah. It's all more cost, and every council, certainly around areas that I see, is trying to squeeze more with selective licensing that's not remotely selective.
Not at all.
It's the whole area. Well, how can that be selective licensing? It's just not, is it? And they're just abusing the system to try and take more money out of it. But what nobody listens to, I shouldn't do this really, but I commented on a Keir Starmer's post the other day on LinkedIn because he was claiming this great victory for renters' rights. And I said, at the end of the day, will you have spent the tenant's money well? Because if you don't understand that it's the tenant's money largely that you're spending, because all the academic research shows about 60 to 80% of rent of any increased cost base gets passed on to the tenant. That's the real world, right? Yeah. Housing is what we call inelastic, right? You don't suddenly get loads more supply because there's more demand. Yeah. In fact, our supply pipeline is completely broken in the United Kingdom at the moment, as you know. So, and that ain't being fixed in short order, right? Never. Well, no, probably not. I mean, imagine 15 years ago, I looked at this and thought, well, there's not, because even then the narrative was there's not enough houses. And of course, people weren't building because the end values weren't there and the mortgages weren't there for people. Yeah. And then Help to Buy came back and did, but it was so often focused on new build. As you know, this argument between, say, 150 and 300,000 homes, it's very political. There's 30 million homes in the UK. So you're arguing over the difference in 0.5% and 1%. You don't move the needle on numbers like that. And you certainly don't do it. But if you know how, I can't remember the stats now, how many we are behind. Yeah. But it's like some people say 3.5 million or something.
Yeah, I've heard, various different numbers. It's huge.
Silly number, which is not fixable. No. Not fixable. So that's sort of where you are, I think.
Yeah, strange times ahead. Just along your journey, I was just wondering that, have you developed it all, or have you just seeked out good discounted stock and sort of gone from there?
So I built one house out the ground. It's the house we live in. It's our family home. Oh, well. So that was a real lucky, that's the case of, the old 3 foot rule, tell everyone what you do, within 3 foot of you what you do. And someone asked me for some advice on some land. We were actually looking for a plot, but we were hoping to do something sort of semi-rural, a bit sort of further south of Birmingham, but further south of Solihull where we live. And he showed me this plot, and someone had found it on Google Street View, and it was B91-1, which is like central Solihull postcode, nearly impossible to get anything. And I was like, right. And the reason why no one had ever spotted it without using a Google Earth or something like that is because they kind of cut off some of their land and it just looked like it must belong to the council. Right. You know, there's a bit shaved off at the side of a property. And he was like, no, that's ours. And so I gave him some advice for just said, look, go to just someone I knew through family connection and go to this person. Land's not really my thing. Go to this agent, this person. They'll tell you largely the truth. Go and see, and then you'll see what it's worth. Because someone had offered him 200 grand, and I was like, well, you know, first offer's going to be too low. Yeah. We all know that. I said, it looks to me like it's worth more like maybe 300. So have a look at it. And he came, and then he phoned me a week later, and he said, well, we've done what you said. Everything you said checked out. It's really good. Do you want to come over again for another chat? I said, sure. Came over and he said, do you want to buy it? And I was like, oh, right. And because he knew us, he felt more. And I was like, well, I've got to go and ask my wife because these opportunities just don't come up, you know. So we did that build. We're very lucky with it in many ways because superstructure was up before COVID started. Planning was okay. I did a good deal with him that worked for both of us where ultimately exchanged but didn't complete till planning was in place and then didn't pay him until we'd sold our old house. So we didn't have to do the caravan thing or anything like that sort of thing. So we were very, very, very lucky on all of that front. And then sold our house, old house at a good time for good money as well. So, and paid nearly no stamp duty on a house that, and I mean, not Angela Rayner wise, by the way, bearing in mind we're recording, legitimately paid the stamp duty land tax on the land that we bought. So that was a big saving because it's not cheap where we live. So that was a big result. So that didn't make me want to go and build 20 more houses though, David, I'm not going to lie. Yeah. And I've done a few conversions. I'm trying to think if I've ever done one to sell. We've held all the conversions that we've done. I think it's a lot of work for the money. I think it's a lot of, and one of the best deals I've ever done was the biggest block of flats. We got the 25 flats that we've got, and I look at things from not just from a risk and return perspective, but from an effort perspective as well. 100%. So since I've been working with Rod, my business partner, he's very good at elucidating how to look at how good. Don't look at what you did 5 years ago because you can't replicate that. We're in a different market today, right? But do think about your effort and how easy is it to get that money back if you lose it? How much money is really at risk? You know, I said I bought a pub once, but I bought it in a fire sale. So a lot of people thought, oh, it's a bit risky to buy a pub. But I was like, well, it depends. Is it risky in a fire sale? When I saw there was 20 other bids for this pub, so I thought, well, the worst I can do really is it's going to sell for roughly the same money if I need to move it on. So I don't think it is that risky. So de-risking things in different ways, but the effort involved, and it's not I enjoy seeing the end product and thinking we've brought something back from, I'm much more of a recycler than I am a creator of new anyway. Yeah. I love the idea that we've breathed new life back into an old building, right? I don't like the process of doing it. Forget the plastering and stuff that we already talked about. I just don't enjoy the moving parts and the herding the cats and John's let us down today, so that's cost us a week. Yeah. Well, hold on, that's X hundred quid or 1,000 quid or whatever it is. Frustrates me far too much. So when you can do the big block that I said we bought, it had a rent roll from day one, same as the other big block I said I bought on the bridge. So we could go through the asset management and a little bit of adding value. We added an extra flat into that block. It wasn't a huge piece of work that we had to do. And those I find much more fulfilling. And ultimately on the spreadsheet, they look better from day one as well. So once you've done, I've always said, try and get development returns from investment property. And I'm thinking of the days where most people try and work to a 25% margin, which again is harder to do these days. But once you've done that on an existing property, you think, well, what sort of margin do I need to work to make a development worthwhile? And you're thinking, well, I suppose 40, 50, 60% margin. And as you know, those deals there's normally some kind of incredible fluke or just a really clever structure, or maybe it's a JV with a landowner. So you might make a 50% margin, but you're actually making a 25% margin sort of thing.
Yeah, I've sort of come to that conclusion over the years. I've done quite a few commercial resi schemes now. I love them, and the end result's been great, and I'm very proud of the buildings I've got. But when I actually look back and actually put a price on my time, like you said, herding the sheep, planners, HSE, architects.
And it's got worse, hasn't it, over the years? That's
and it's only going to get worse.
Planning now is not a touchable thing, I don't think. No. If it's not PD, I wouldn't even contemplate it. But obviously that gives some people an edge because if they can be bothered, But now you're looking at 2-year options to kick things off, and it's like, as long as you've got bread and butter in the background, but if it's 2 years to get planning, when are we getting any money out of this?
You're locking your money away for so long.
Baked beans on toast for however long. It's all right if if it's 100 grand's worth of planning fees only, and the GDV's 10 million quid. More power to you. And I know people who do that, and they do it very well. They're very skillful. It's what they do, and they enjoy it. And there's a bit of uplift in that, and they don't lose on many at all. They're pretty good. But that's a different skill in itself, and that's I think is a full-time business in itself. Because you need to give so much attention, and then it's the relationship building with the vendors, and then it's the competition side and the sometimes getting shafted side, or some of you get swiped from underneath you, or you find out they've put in for planning on their own because you've had a chat and you've said too much, or whatever it is. More power to the people who do that, and we need people who do that in this country. Little that we do to encourage them. In fact, we do everything we bloody can to disincentivise them, but that's a
seems that way at the moment, unfortunately. So what have been your main obstacles, would you say, Adam, and your main failings along the journey? You've done so much, you've achieved so much, but what have been your main obstacles? There hasn't been that much that's held you back, clearly, but what have been the main obstacles?
Yeah, to an extent. I mean, I think what I got good at was reading the market and the opportunities before they came along. So going back to that framework I talked about earlier, I would sit down and look when we're talking about scaling, not just, and this is what, because you're busy and there's so much going on and you need to wear multiple hats. The idea of get deals, do finance, manage, that's at least 4 different skill sets and arguably 20 different skill sets that you need to do that well. So that's not easy in the first place. You need that generalist skill or to plug in specialists where you need them, don't you? So but what was good for me was not just waiting till things had happened before I tried to fix them, but looking ahead and looking at least these days, 12 months at least. These days I look 5 years into the future because I'm thinking about the next election cycle and I'm thinking about the future of the bond yields and where I want my debt to be and stuff like that. So very, very strategic long-term planning and then removing the bottlenecks before they get in your way. So a really simple example of that would be, if you work out, and if people are developing, if people are doing commercial to resi, they probably top out at about 3 projects. The most talented guys and girls that I've known in this game, 3 projects is enough. And it's the old London buses. They all bloody want to start on the same day, even though you thought you'd staggered them nicely. Yeah. This one goes well, this one goes badly, and suddenly you're needed everywhere at the same time. But what you don't do then is stop looking for deals. Yeah. Because if you do, then 1 or 2 of them are over, and then you've got that bereft period when you're like, right, okay, so all of these have got to be constant little conveyor belts on their own. Now, what's going to get in the way? Is it money that's going to get in the way? Now, is it deals that's going to get in the way? Is it, have I got my own build team, or have I got a good team, which I know, and people I think get sucked into this sometimes. I can buy that because I can deliver it cheaper. I teach people not to do that because I'm like, no, you need to get paid for your advantage. So don't just outbid me to do it. Do deals that are as good as me, right, or better than mine, and then have a cherry on top because you can deliver it cheaply.
Otherwise you're losing that margin.
Yeah, otherwise, well, the people sometimes, they're like, oh, I'm really well in with these agents. I'm like, all right, show me a few things you bought. And I said, well, that's what I mean. Have you overpaid for that, right? Appraise that as a normal development. You're amazing. You're delivering at £1,200 a metre, or well, maybe not these days, but maybe something like that. Well, that's amazing. I hope you're getting paid good money for the amount of extra edge you're getting. Because like I said, that's where the big effort is. And it's where the time is. And returns in property are about time. Like I said, time's a great healer, but also we want to get big returns over shorter periods of time if we want to scale. Because that's how we have to do it, right? Otherwise, otherwise you're just leveraging up a big ball of debt behind you all the time. And at some point, if something goes wrong, it's a problem. I've been the beneficiary of a couple of sort of market changes. The big one really would have been the 2024 budget, because I really sort of saw it coming when they got elected, heard the chat, really got the feel of the nation's feeling, and bought 103 properties in 2 months, right? Now, that was way over our capacity for multiple reasons.
On the back of that budget?
On the back of the before the budget.
Right. So what was you thinking? You went up about 104.
I watched Rachel Reeves and Keir Starmer talk to the nation, and they were both so miserable. And I started listening to the chatter. Capital gains tax is going up. It's going to be 40%. That was the thing that was driving people. They're going to take, and then people start retreating into this fear. They're going to take all our money. They're not going to do that, right? And actually, if you the littlest bit of research would have shown you, HMRC said if they put capital gains tax up, they'll take less money in. We knew she needed more money in. Yeah. So even if she wanted to, she wouldn't have done it then, right? But these people didn't listen. People don't. Fear drives so much more. Buy the rumour, sell the fact.
Yeah.
And I just saw it with absolute clarity and hammered it, and I'd raised some good money at the time. Everything fell into place really, really well. And so there was definitely skill in doing that, and there was a bit of luck as well for that time. But then we were over full in how much we had to get through the pipeline and things like that. So it was very, not feast and famine in a way, but then it did compromise a few of my deal finding relationships, because I was like, well, we can't buy it, or we're offering here at the moment. And the problem was, even the November, December, January, February, the shock of the 5% stamp, a lot of people withdrew from the market. So we had to keep buying because the deals were too good to turn down. But then it's like, well, there's a capital swing. A couple of things happened, like sometimes outside of your control. A couple of people wanted some money back. I didn't have to give them the money back. But again, long-term relationships, force majeure, genuine situations that I'm not going to go, well, sorry, mate, we've got a contract, because we've got a working relationship we've had for years. Find more money, do this, do that, distractions. And then it's like, well, actually, maybe we do need to hold off on purchasing for a bit. So the good and the bad of that side of things. So that is a macro-driven, environment-driven. At the moment, the equivalent Renters' Rights Act, interest rates have gone up recently. Market hasn't quite reacted as I thought just yet, but I'm watching the auction results this month very, very closely, because I think there's a bloodbath somewhere around the corner.
Do you?
Yeah, in terms of rental properties that are already rented that are selling, I'm expecting them to sell very, very badly, because people are struggling to price the new risk. And I'm happy. I've already done it. I'm happy with the work that we've done. I know exactly where we want to be and need to be. And I know, because of the half a dozen or so property traders I speak to regularly and deal with regularly, it's when they're contacting me, not me reminding them that I exist. It's like, are you interested? And it's like, we all know we're all experienced, right? We all know what it means. You're calling me because you haven't got any other buyers, right? And I'm mad enough in your eyes to be buying, even though you're mad in my eyes. But we work well together, because you don't want to hold it. I do want to hold it. We're happy to sort it out. Let's do some business. So I've given a few of them a few tips on, this is where I want to be. This is why.
So you're just reducing your purchase prices, basically.
Yeah. Well, you've got to price in extra risk, and that really is all it comes down to. That there is extra risk. If stuff's, we haven't got full compliance, well, welcome to a 2-year rent repayment order. Yeah. That wasn't the case a couple of months back. It now is, right? So do you want me to just take the extra risk and not be rewarded for that? Because that's not really how we work, right? We price risk, and that's what we've always, when I ran betting syndicate, I priced risk. Yeah. When I worked in financial services, I priced risk. I built portfolios. It was everything I've ever done is price risk. Yeah. And that's, to an extent, that's property and life. To an extent.
And you've seen that principle filter through to other investors. You're obviously ahead of the game there. I don't feel like investors, certainly in this area, are adjusting the purchase price. I think they're just going hammer and tongs at the moment.
Well, I think geographically being where you are, there is a bigger thing at play here, because if we were recording this in central London or somewhere in the southeast, right, then ultimately they'd be saying, oh my God, I'm having people whisper to me, market's terrible and stuff like this, and we can't sell anything, and this is going on. And there is, there's blood on the streets in prime central London, definitely. Yeah. If you really need to sell at the moment, boy oh boy, you are going to take a 20 to 30% haircut. Yeah. Unheard of in London. And that's from a suppressed value that has limped over the last 10 or 12 years. Yeah. So it's a big old bath, right? But the landlords you've got a choice, haven't you? If you've got a big portfolio down south, and especially if you've still got stuff in your personal name, you haven't sorted out incorporation or anything like that, you can either sell up, right? You then find out if you want to sell your portfolio, there's a discount. So then if you want to sell up over time, good luck with that 10-year process you're about to embark on. Let me know when you get fed up, and I might do you an offer, But you're going to buy any more at 5 or 6% yield? I don't see how you can. Yield is not everything, but if you're starting below the mortgage rate, how can you? I don't see how you can make a business case for that. Obviously, if a cash buyer, different kettle of fish. But they're priced out. So leverage buyers are out. So that money has to go this way, or maybe west into Wales.
Yeah.
And it either gets all the way to Scotland or it stops up here where there is. So from the get-go, well, you know what? It works. It works. Can you get deals? Yes, you can. Yeah. So why not? So you either stop or buy cash and hold. And I speak to investors all the time who are got great portfolios in Winchester, Bournemouth, places that have had mega capital growth. But at the moment, they are just sitting on it going, well, actually, we're holding capital at the minute because we're refinancing. And sometimes we're having to put more money back in on a 5-year. So they're not making their 2021 values. Yeah. And if they've had commercial vals on HMOs, and that's not just on the South Coast, they're having to come up with some chunky 5-figure sums and sometimes 6-figure sums because it was valued on a 7% yield in good old 2021. And today the value is your rents are up, but it's 10.5% yield around there now.
I wanted to get your view on that and just in general, because people get quite passionate about it.
I've got one.
Yeah. Good. I hope so. But yeah, what is your view on people doing these? I know a lot of guys doing them in the Northeast. Bricks and mortar valuation, 200k. Commercial valuation, 350, 380. Beautiful HMOs like we touched on earlier. But for me, that just doesn't work.
David, I am not a don't do it kind of guy. I am a be very careful and understand what you're doing kind of guy. So have a portfolio of those, lunacy. Do not have a portfolio that looks like that. You're completely over leveraged if you can get that financing, right? If you've got mega cash flow and it's steady, so you can guarantee, so we're not talking professional HMO where, they've gone in at 800 because it's a nice shiny new room and in 3 years' time they're in at 650 or 700 and it's a 6-week, 12-week void between rooms and things like that. You've got a big problem. So you've got to get your numbers spot on. Don't be lured by the commercial val day one. Can you swallow them if you've got mega cash flow, if you've got other assets? Yes, but understand what you're doing. You're taking all your money now and maybe some more on something you'll never sell for that money. So if you have, what extra return do you need for that extra risk that you're taking? And you've got to look at it like that. And I worry about those. I've spoken about commercial vals since 2015. I said to people, the lenders, these are going to go wonky one day, guys. And we've survived this interest rate normalisation or whatever you want to call it without there being blood on the streets of a few of the lenders who maybe might listen to this and might know that they've got books that is not toxic, but it's not the sort of stuff I'd want to have carrying too much.
And it does make you think. Could it be even responsible for the start of the next financial crash?
It's an interesting question because it's probably not, because the exposure is not high enough. There isn't in our bubbles that we move in and the network communities we go to.
Yeah, I think so.
But vast majority of rental property single let, half of it is unencumbered.
Yeah,
it's not big enough to cause certainly a financial crash, but it would be enough. That risk is concentrated in a few lenders. I won't name them to embarrass them, but people will know who they are, and they will be the outliers on the graph because it's actually 14% of our portfolio is HMO, and actually 2% is in L9 or somewhere like that. It's drastically overexposed to commercial val HMOs. But then when the music has started in this game, everyone's incentivized to keep it going. 08 only happened because it was like, we've got nowhere to go. And remember, the banks had no money, so they needed to get money back. So that's when they started swiping stuff. They wouldn't, at least 6 months when the writing was on the wall and people were like, let's just pretend it's okay. We'll just whistle along, everything's all right. It's like, well, we all know it's not, because you couldn't sell stuff. Everybody knew it was gone, but it didn't go for months and months and months. Right. So, and I do worry. I worry about title splits being the next one of those, because sometimes these buildings are being split and you're thinking, how are you going to sell 12 flats in that one location at that full fat price? It's not real. Now, again, that doesn't mean don't do it. It means understand the risk inherent in what you're doing, and please build a cash buffer somewhere or have some pledges somewhere. Don't start living on what I really dislike about the sort of guru-y, sack your boss, you can replace your $2,000 a month, $3,000 a month, whatever, pick 10 grand a month, pick your own number, right? If you think that then means 10 grand a month and you're financially free, if you're spending 10 grand a month, you're a financial prisoner, mate. Okay. So don't, keep going to 20 a month and put 10 away and keep it liquid. Because if you're going to over leverage, and that is over leveraging, you've got to be liquid somewhere. Right, got to be liquid. 100%. Don't do that at 85% loan to value because you've got angel money in and you've got this and that, So if it's 200 bricks, your example there, and you're saying 350, 380 commercial val, and it's 200 bricks, please don't be in for more than 200 on the bricks. And then if you want that extra 60, 70, 80 grand, 90 grand, be sensible with it, for goodness sake. Nothing wrong with it, as long as you know what you're doing. But there is a level of sophistication that is inherent in that transaction that I do fear that some people don't have.
Yeah, I totally
like being
agree
trusted with a loaded shotgun or something. Really.
Yeah, exactly. And I think a lot of people that I know that are doing that model, they're only in that model. There's no...
Because it's the way they get deals. It feels like a deal because they can get the money back out, but they're in at 300 for something that's worth 200.
Yeah.
That if it gets swiped, is gets sold for 140.
Yeah.
Do you want to owe 300?
And then your long-term exit, you're selling to a landlord.
Yeah, exactly.
The landlords want discounts.
You've got to hold for 10 years, probably, realistically, if you're into it for that much. Or I very rarely does someone lay a present of a 25% deal on my desk, but someone did. It was an HMO in Derby. It happened to be a while back, and they were like, "You can have it at 25% off the commercial val." I said, "Oh, jolly good. Let's have a look at it." So this was valued based on, and the rooms were getting 850 and 900, but I spat my tea out because that's not the money. No. That's the money for the brand new, perfect condition, all the rest of it. Got a re-inspection report today, have you? No, you haven't. Right, interesting. Oh, that commercial val was done in early 2022 when the rates were, and it's like, I knew all of this, but it's like, you do know you're a long, long way off where that needs to be to sell it, a long way off. So yeah, be prepared. So if you need to find other ways of getting deals, lazy is the wrong word because it's a lot of effort to create an HMO, but find other ways of getting deals. Definitely to supplant it. Nothing wrong with quite a few people come to me who've done like 2, 3, 4, and they're like, again, they whisper it, HMO's hard work. And it's like, yeah, it is. Yeah, it is. Can you teach me to do some of what you've done? You know what I mean? Because it's like, I was like, guess what? It's still hard work. Yeah. And you don't cash flow mega out of one single let. It means you've got to be looking at doing double digits worth to make it worthwhile. Yeah. But you can. But it has to go probably 1, then 2, then, and it's just, but then nearer, of all the ones I bought, the vast majority of them have been bought since 2016, and a lot of them have been bought since 2020. Yeah, because it goes up like that. Although because of the macro stuff that's gone on, it's been jerky around. Like I said, that budget was a most incredible purple patch we've ever had, but sometimes the stars just align a little bit for you, and you're in the right place at the right time, and you've made the right read, and you're well capitalised, and all of that, and it was just like, bang, make
the most of it.
Yeah, absolutely.
In general, Adam, how attractive do you think the UK property market is to retain property for investors in 2026?
It's a great question, isn't it? I think some of that will depend upon whether you're based offshore or not. I mean, if you think there's been a significant realignment geopolitically, let's say, so people who were putting money, people all around the world who've always quite liked the UK market, maybe we're putting money in Dubai, probably not putting that money in Dubai anymore. No. So that opens the rest of the world back up, not just the UK. And that relative stability, now stability maybe is a funny word to use at the moment because PM's on his last legs and the bond markets are wobbling on the back of that because they're worrying that, the Ginger Ninja or whoever is going to do her darndest. Again, that's the fear bit. Once the Chancellor is in place, whoever that's going to be, at least they'll know where they're at, but and again, the strange thing about the whole Trump thing, not taking a political position on it, but ultimately he doesn't care about the law. So he has a flagrant disregard for the law, right? And then just says, I'll break it. He does stuff, then he apologised later. Well, not even apologise, but you know what I mean? Fight him in court. The tariffs have been a whole saga of all of that. Yeah. So he's compromised, in my eyes, the US legal system. Now, the UK's got the strongest legal system in the world. It always has had. So if you want your capital to be safe, and a little bit that comes back to the Middle East, you want your personal body to be safe, but you want your capital to be safe, you fly to a system that is ultimately under control and not so volatile. And at the moment, until Mr. Polanski gets elected, which will never happen, right? No. I need more than God to keep him out. But we're not compromising private property rights in the United Kingdom. Your money is safe if it's there. Your money's in Dubai. You never own the freehold anyway. No. Sheikh owns the freehold, right? It's always been the way, always will be the way. So it's put things back into context in that perspective. If you live in the United Kingdom, look, if you live in the Channel Islands, you live in Guernsey, and you own a portfolio on the mainland, you don't pay corporation tax. Right, so that's pretty attractive. And I think you've got stability, you've got rent growth, you've had again, it doesn't make the papers, but wages are up 40% since 2019.
Yeah, massive.
Right, so people can pay rents. Right, they can pay rents. There's the usual rhetoric around all of that. And I'm not saying the cost of living hasn't gone up, right? But wages are up 40%. So you're only worried by where the tax freezes are, really, if you're in the 50 grand plus bracket. Average tenant is not in that bracket, especially in sort of part of the country we're in. So therefore, what's the problem? They've actually just had an 8% pay rise here and a 4% pay rise here and a 12% pay rise here. And they're in good shape. So their affordability is not compromised. No. So I think that's attractive. And I think the gap, one of the things I started out thinking as a good idea was the fact that you could buy below replacement cost. Yeah. And in the Midlands, certainly. Around here, absolutely, definitely. Yeah. Scotland, absolutely, definitely. So, and that gap was significant when I started, but maybe 20, 30, 40%. That gap regularly these days when we get stuff revalued, full rebuild is double what the value of the property is deemed to be. Now, what does that mean when you unwind it? If someone's going to build new, and of course, in a lot of 48% of the UK is unviable to build, so it only works with grant money anyway, right? But the grant money needs to be more and more, so they're getting less and less bang for their buck, the government, with the grant money they're putting in. So they need to repurpose old stock or survive with the old stock. So the new stock drags up the price of the old stock over time anyway. It's very, very, and I think this is what people don't understand when they look at other investment classes. Crypto has been a bit of a classic at the moment. The volatility is immense, more than most people can handle, right? Stock market, there's still volatility. There's good returns to be made, but if you're the person who's going to open the app every day, every morning, every hour, don't do it to yourself. Do you know what I mean? You don't do that and you can't do it to your portfolio, because what's the point of valuing it every day? You can't realise the money because it takes time to sell them anyway. So it's very, very low volatility, still really quite low risk. People might argue with that after renters' rights, but I still think really quite low risk.
I agree, yeah.
There's effort, right? Definitely there's effort. And if you take things personally, there's definitely stress, so that you've just got to not take them personally. Business is business, and this is a business, and I've been saying it ever since I started in it. It's absolutely a business, and if you don't like that, tough luck, because it is. And the returns are medium to high. Well, when I learned in wealth management about how to invest in stuff, you couldn't have low, very low risk and medium or high returns. That asset class didn't exist, but it did, and it does, and it still does. So people understand bricks and mortar. We haven't had, look, we're 23 plus years away from when property was last time this cheap when adjusted for inflation.
Saw that, yeah.
23 years. Now, that I'm not saying we're at the bottom of the inflation adjusted. In fact, I'm pretty certain we're not at the bottom of the inflation adjusted, because inflation's about to go up again, and the market's going to go sideways-ish. Although, as you said, in the north, I think the southern money is bidding up a lot of the investor market. So prices are moving in the Darlingtons of the world and the surrounding area. They definitely are. And they're just being counterbalanced by them dropping in London and the southeast. But, what's not to like about low risk, medium to high return if it's leveraged well?
100%, fully agree on that. Where do you think we are in the property cycle right now?
I love this question, because
I had to ask you.
I'm not a huge believer in the cycle as it goes, not as it's framed, as in there is an answer and it's an 18-year cycle, because it won't have escaped people who can do mathematics notice that it's 2026, and that means we're 18 years into the said. Someone even calls it the 18.3-year property cycle. It's like, why are you trying to be so precise on it? It's just silly. This cycle has been affected anyway, even if you do believe in the... And look, you do have bull sides, you do have bear runs, you do have bear traps, definitely. They don't always look the same. And a pandemic, apart from anything else, a 1 in 100-year event messes with the cycle. All the cheap money messed with the cycle. We had nearly absorbed the interest rate normalisation before what's happened recently has happened. Now the swaps have shot up again, and we're paying a bit more for our mortgages, and that gap's widening again. But we pretty much absorbed, the shock absorbers had kicked in, and it hadn't impaired the price of property terribly. Inflation had done the heavy lifting. The nominal prices had tickled along a bit. They were all right. So are we having a crash this year or next year? No chance in the world. Now, you could argue, well, hold on, there's already a crash happening in London. I've said so myself. I don't think that's necessarily a cyclical thing per se. I just think you're more expensive. London's been hit from two perspectives. Number one, yes, you earn more money if you work in London, but the property's so much more expensive. It hurts you more proportionately if the interest rates double, which is what's happened, right? Number two, people who would have come to London or people who were in London have moved elsewhere, made preemptive action when Labour Party won, action before the Middle East thing. Will we see people coming back in? Do you see people coming in from America? Speak to people who sell super prime property in London. I've had a conversation with a couple of them, and there are people. It's not what it says in the media, but the numbers are bad in London. So if you are Fred Harrison, maybe you can claim the crash is happening in London. It's a bit dishonest because it's not a cyclical thing, I don't think, that's made that happen. Are we having a crash in the next few years in UK property prices? I will happily go on record and say no chance in the world.
Why? Why are you so confident?
Leverage is low. 20% loan to value, the average mortgage. We've pretty much absorbed that interest rate repricing that I talked about. No real growth in 23 years. We can't build. We're not building. Building's getting worse and worse and worse. Where's the catalyst? If interest rates went to 8%, but believe me, they wouldn't, because something would break before that, and then interest rates would drop because we'd be in trouble. It's not a real recession.
No, the government's debt would break at 8% before anyone else's, I think.
Well, I have a little soapbox about that because, again, this gets talked about. At the end of the day, the government's servicing debt interest about 110 billion, right? And we owe about 3 trill. So if you do the maths, that's about 3.3% on the outstanding stock of debt, right? Now, today, 10-year, 5.1% to get new debt. But it's only new debt, right? So it hurts, but it doesn't hurt as much as it looks like it hurts. Now, that's not an excuse for the government to carry on being idiots or whatever and keeping the bond yield high and having more on premiums and all this sort of stuff we've had over the last few years. But it's not as bad as it's... Just because you had the bonds have a bad month doesn't ruin the UK from that perspective. And ultimately, look, we're paying higher rates on our bonds than pretty much anyone in the EU these days. Even people we're in better shape than, definitely more than the Americans, even though their debt is just eye-watering. They borrow an extra $1 trillion every quarter pretty much at the moment, and they owe 36, 37 trillion. I've lost probably 38 trillion, but I haven't looked at the clock for a couple of weeks. So it's probably 38 trillion by now. We're in better shape than all of those economies, realistically. Well, not all the ones in Europe, although we have been growing okay, in spite of, the best efforts of the Labour Party to knock us off track, to be honest with you. Luckily, they're not that effective in doing that. So the debt is what it is. We're not in any significant trouble anytime in the near future. We'd be much smarter if we hadn't issued all of the index-linked, inflation-linked debt that we have. Again, Conservatives did it. Labour carried on. Both of them are pretty stupid. Obviously, none of them read the supplement. Otherwise, they would realise they should have been doing fixed price debt, as much of it as possible, and getting rid of the index-linked stuff, because inflation was always going to hang around. And now we're, 5 years into being above the inflation target. Yeah. And we've got 18 months to go, at least, I think, realistic, before we get down to the 2% again.
Is there an argument to be said then that we have had a crash in real terms, UK wide?
Now that's more difficult to push back on, because ultimately 2023, I think even I predicted we would lose 3 to 5%, and I think the ONS figure was -2% at the end of the year, -2.4 or something like that. That was on the back of the whole Liz Truss situation, but remember, we had 11% inflation. So when you look at the real terms adjustment just in 2023. I think the average rate of inflation during 2023 is about 7%, something like that. So we pretty much lost 10% in real house price terms in 1 year. Is that a crash? Well, look, 2008, the actual peak to trough on the ONS, which obviously is all the houses around the country smoothed out. You could definitely have found a block of flats in Newcastle that sold at 100 grand that was then trading at 50 grand 8 months later. They definitely existed. But the aggregated data said 18.6% peak to trough. So that was the nominal movement, less than 20%. Most people don't realise that. You go back to the late 80s, early 90s, and you saw a much bigger, certainly in real terms, adjustment, because inflation was really high and it was multi-year, and it was more like a 40 to 50% real price adjustment, peak to trough. But nobody ever talks about that because they don't remember, but what happened back then, again, why is that not replicated today? everyone goes on about the interest rates going to 18%. They forget that it happened for one day, and a week later they were back down to 8 3/4, which still sounds high, but there was a big readjustment. Loan to values are much higher. Most people were on variable rate, not fixed. The mortgage market structure looked different. So all of those were, and of course on the back of that, there were millions of repossessions, which we just didn't have. Even 2008, it picked up, but it wasn't like it was in the 90s. And these days, you have like 600 repossessions a quarter and things like that. I mean, the banks don't want to do it, don't need to do it, try to put pressure on so they don't have to do it. It's bad for reputation. And the FCA have lent on them really hard, so they don't have to. And they're so well capitalised because of the changes in the rules since 2008. Yeah. They're not in that point where they go, well, we can't lend any money. Yeah. They don't find themselves in that position, so they don't need to swipe those assets.
It does feel like we are, I've never gone as deep as you've just gone on your metrics there, but it does feel, just being in the industry, that we are a lot more well insulated financially.
Very much
in the lending markets.
And this is the thing, and going, UK property, why is it attractive? Look, and why I've always been a crypto skeptic, right? It's utility, as in how useful is it? And you could bring AI into this conversation, right? How much risk is there in being a property investor from AI? Well, indirect risk, probably, because what if your tenants can't get jobs? Mm-hmm. There's a world where that happens. Probably comes back to the COVID. What if everyone's on universal credit, becomes universal basic income?
Yeah.
Not sure about that myself, if I'm honest with you, but there would be a world where that plays out. But ultimately, Elon Musk sort of like, oh, nobody needs money anymore. Well, lend us 100 bill then, Elon, my old mate. You can afford it. I see that as a bit utopian, if I'm honest with you. I think 5 or 6 people pretty soon, if we're not careful, will control 50% of the world's wealth. Yeah. And you will see, I would predict within 10 years, you'll see S&P companies with a market cap of $50 trillion, genuinely, because the amount of theoretical value they could add and their growth rates and what they can do at the margin they can do it is going to be utterly frightening. If Elon's anywhere near with his robotics predictions on top of the AI, it'll be an incredible thing. But coming back to property, what does that mean? We're insulated from that, right? The humans still care about the humans, so they still need roofs over their heads, right? And so will it suddenly become cheaper to build property? Well, A, land values would go up. B, unless the robots are doing the planning and they sort it all out as well, it's still going to be, well, some planners are a bit robotic, aren't they? But robotic at ticking no and bat surveys and stuff like that. Yeah. So, and regulation, look, under this government, it's not going down. They've lied about that, really, haven't they? They've absolutely lied, and they've got in the way of, and they're getting in the way of houses being built. They're actively getting in the way. It was the Conservatives, it was Michael Gove that introduced a lot of the stuff that came on the back of Grenfell that was really Gateway 2, high-risk buildings, humongously problematic, ridiculously 300,000 unbuilt units in London based on planning permission because clogs at Gateway 2 not viable anymore because build costs have gone up so much. This is what's happening right now. Sadiq Khan's target 88,000 homes a year in London, building 6,000. I mean, 90-odd% failure. I mean, laughable. So that's not fixing anything, right? And there's still going to be humans. I appreciate the birth rate's down for a multitude of reasons, right? But ultimately, we're going to be living longer because we're obsessed with making ourselves live longer, right? Apart from anything else. Yeah. So even if the existing, we don't need the birth rate to be up for the next 40 years if we're all just going to start living to 90 and 95 because there's so many medical advances, then the cost of that on the NHS, then you start getting into some really interesting numbers around, economic growth and taxation. My prediction around that is taxation will change immeasurably, primarily around things like consumption taxes. So the more you spend, and it's something that I would do if I was anywhere near Parliament, I would say, look, more luxurious goods, higher rates of VAT. Because VAT is the best way to get the money. Because people who've got lots of money still spend it. Yeah. I read a stat that said the average non-dom, who we've basically forced out of the United Kingdom, well done. Both Jeremy Hunt and Angela Rayner, to be fair, both sinners, and Rachel Reeves, all sinners in that department, right? Contributes £850,000 a year in VAT. Well, I don't care if they don't pay income tax, Dave.
Exactly. Yeah.
850 grand of VAT. I
didn't know that.
No, well,
it makes sense. Yeah.
It does because they're worth hundreds of millions, billions. They probably
never gets mentioned, does it?
They employ 12, 25 people to look after their cars, look after their house. It's like having a small company. That's what it's like. So again, it's not thinking, it's ideology of, or not slighting this against the Labour Party, all political parties. If you're being ideological, you're probably doing it wrong.
Yeah.
It's not about, my ideology is show me the incentive and I'll show you the outcome, Charlie Munger, right? And I've seen that play out so many times in my life. That's why I believe it. That doesn't mean that solves everything at a governmental level, right? But that's where it is. So look, the future will be interesting, but property is really well insulated from some of those bigger risks. And I think, look, the one on the bright side, productivity is going up and will increase with AI 100%. Over and above some of the terrible forecasts we've had. Health is a big one. Will we be wearing wearables like this one, but they do more and more and more and help us have more quality, healthy years of life? Will assisted dying be passed and people get rid of themselves when they're not having, because the average person is having 10 years of non-quality life. Now, that doesn't mean they should whip off to Switzerland, right? But we know there'd be plenty of people who would probably take the pill or whatever it would be, right? So that the productivity side, and then the last one is the climate change, right? And ultimately, for us, being selfish about, which I believe the Prime Minister should be, about the United Kingdom, this is a rainfall, volatility, and volume argument, right? So flood defences are going to be interesting over the coming 20, 30 years. I'm not worried about the sort of net zero argument. I think that sorts itself out. I think it gets politically very emotive and everyone's getting it wrong, to be honest with you. Everyone involved in the debate at the moment is getting it wrong. It just needs, nuclear power needs sorting out. We need to get on with some stuff. We need to get the private sector delivering those small modular reactors, people who want to power data centres, blah, blah, blah. But there's an absolute metric ton of money going into the grid by 2030. It needs to. It's already allocated. This is part of one of the good things about the Labour Party, 378 billion of infrastructure investment in the UK over the next 5 years. It's allocated. It's happening. That will bring economic growth. It brings jobs. We deliver those now. If you get that delivered by EDF and it all goes to France, it still doesn't all go to France because the contractors come from round here to go down to Hinkley Point and make good money, right? Yeah. But it would be better to see us deliver more of that with domestic, keep the money onshore would be a much better idea. Yeah. But there's not all, it's not all negative there, you know, especially around AI and productivity, but there's definitely an argument that health could and should get better. Certainly hope so. There's a huge disparity between the northeast and the southeast of the country that is wrong. How much is educational? How much is economic? No, I'm not an expert in that area, but I'd like to see that improve. I think lots of people would, and I think people are certainly. There are people online who are much healthier than they were. Unfortunately, not all content around that is driven towards good stuff, and some of it's quite negative. But I think social media will get regulated over the coming years because at the moment it's still the Wild West. Yeah. And what people can promise, whether it's dodgy tax advice or whatever, governments are just slow in these situations, right? And hopefully it'll fix itself. But we are very well insulated from a lot of that by owning and renting property. Agreed. Even if look, when Corbyn was nearer to 10 Downing Street than any of us would have liked, right? John McDonnell, who, remember, was a man who was on video saying that he was a Marxist and laughing like some kind of maniac, right? He said that himself. He had an idea of buying back properties from people at the market value or a bit of a discount and paying no CGT. Yeah. Now, take him, John. 100%. Go on, crack on.
Imagine what an exit that would be.
A dream, right? Polanski, not so sure. No. Right? Now, likelihood of Corbyn, 40% of the vote. Polanski, he's never getting 40%. Is there a coalition? Even if there is, even if that guy was the Prime Minister, I can't believe I'm muttering those words, but they wouldn't have the Chancellor as well. No. And there would be enough in there. They'd have to have Labour and the Lib Dems. The numbers don't work otherwise. No. And even though that sounds like a bit of a nightmare, the reality of that government would be nothing would get done because everything would be blocked. So whilst I'm not enthusiastic about the 2029 election, I don't mind telling you, I'm nowhere near as worried as, when it was Boris versus Corbyn, a new Boris would win, right? For probably the wrong reasons, like people liked his hair and he's a funny guy and stuff like that. But you knew he could beat Corbyn because of the personality on its own. and the lovable rogue, whatever you want to call him. But I still wasn't happy because I thought if he gets in and like all good socialists, from his £1.8 million mansion in Islington with no mortgage on it, he can tell everybody else what to do with their. We'll start taxing people who've got a house over £1.81 million because that's too expensive. And it's like same as Polanski in his houseboat, right? Okay, you tax avoiding buggers, but
exactly.
No, I don't pay it. No, I'll do whatever I can not to pay it. And it's just laughable.
It is
laughable.
Do you see the money continuing to flow from south to north?
For the foreseeable future, yeah, great question. And I think so, yeah, because people are hanging on, I think, so where down south they've had good capital growth over the lifetime of an asset, not a lot of that has come in the last few years, or it's even been slightly impaired. But they're struggling to sell them at the moment. Only one property in 3 in London being listed at the moment is actually selling. The other 2/3 are being withdrawn from the market. That's how bad the market is down there. And this is what you normally see. You see a collapse in the number of transactions. You don't normally see a collapse in the price. And of course, down south, there's more unencumbered stuff that's worth more money. So they can wait. And of course, some of these, I think quite a few of these, they try to sell, then they just go back on the rental market. Because what exits do you have? You can sell it, you can rent it. You can leave it empty and they'll start on the double council tax and all the rest of it. Well, you don't want to do that. So those are your choices. So I think a lot of the money's sitting there, not doing that much. And remember, a lot of landlords are still 1, 2, 3 property. They're not professionals. They probably work a pretty decent job. That's why they've got the money to be able to have more than one house. Mm-hmm. They don't need the income from it necessarily. They're not happy about renting it because of renters' rights and they're very worried. But do you know what I'll do? I'll just get a really good agent to sort it out for me. And I'll worry about it when the tenancy ends. And I'll sell when the market gets a bit better. Mm-hmm. But at the moment, there's still a big, average house price in the Northeast, 183 grand. Average house price in London. And I say house very loosely because most of them are flats, right? 568 grand. So there's plenty of gap, right? There's still plenty of gap there. So there's still plenty of money that could come in. There's still good yield. While the bond yields are wobbling still, it pushes. I said to you earlier, didn't I? First reason I came to invest in Middlesbrough is because I needed some stuff that was yielding 9+%, and I couldn't find it anywhere else that I was happy investing in. Yeah. Because of Teesside Valley regeneration, I was like, it stacks up, all right, no problem. Let's get it on. That wasn't mega scientific, and I'm sure people have done more work than I have in the background and gone and made the same. And actually, when you talk to a few southern investors, there's quite a few who've always invested up in the Northeast and they press on and they've built, got good double digit. And you see that around here a lot. People who've got lots of double digit numbers of portfolios. Yeah. They're not necessarily worth loads and loads. It's not like having a double digit number of portfolios in Southwest London, but they're still a few quid and they're reinvesting. They reinvest the money and they like, if you've got them organised right in a limited company or even in your own name and you're writing off some of the refurb monies, building makes sense because you're then not paying HMRC legitimately and reinvesting it in the future. Yeah. And this is a game for the future. So it's going to take a while before... I have started to hear people say recently very specific geographical examples of, well, actually, you can buy a house down there now in that area, that road, that street, and it's not that much more expensive now than this house over here. Mm-hmm. So it is definitely starting. It won't go on forever. It's definitely, leveling up. Yeah, they don't say that anymore, do they, for whatever reason? But it definitely has worked a bit. But then fair enough, because they have pushed a lot of jobs out of the southeast. And if you are struggling because now your resi mortgage, as we're recording this, is probably 4.75% for a 5-year, that makes it tough down south without a whacker of a good 6-figure deposit. Yeah, for sure. Whereas around here, especially on a 95%, you've got the income. You've got plenty of choice if you want to buy, if you want to make the sacrifices to buy.
Yeah, 100%. We've touched on the Renters Reform Act quite a bit as we've gone through. Are there any elements of it that are putting you off investing further?
I mean, I've never done student, and if I did, I wouldn't start today.
No.
Right? So student, but on the flip side, and again, I appreciate I'm in a position to be able to say things like this, I would look at buying purpose-built student accommodation because they've now got a material, totally unfair, quite frankly, strategic advantage in that they can still use the fixed term. Yeah. And the student HMO can't. Now, again, the opportunity on the flip side of that might be someone who's got a student portfolio is out of ideas, whereas you might be able to repurpose for professional within the caveat of the conversation we had earlier, or social within the context of the conversation we had earlier. So if they're in Article 4 areas and they've got that planning permission barrier to entry in place, there's still a material value to that. So there's opportunity on either side of the fence on that side of things. But I much more try and look for the opportunities than the negatives, or turn the negatives into a positive or an opportunity. So student aside, look, I said earlier on, it makes the social leasing, the lease to a provider, more attractive relatively, because not everything is about when something gets worse. And look, RRA is worse for the landlord. Let's be fair. Now, it might end up being better for the likes of me and you, because there might be more opportunities that we convert. So that's how we make it better for us. But in a vacuum, it's worse, right? But what's relatively worse, some stuff, student HMO, has got a lot worse. Some stuff has got a little bit worse, because now your biggest worry is 3 months arrears rather than 2. And look, in fairness, we're worried about court delays and things like the initial teething problems. There's going to be issues around that, but we're seeing this at the moment a fair bit. We had a tenant, 1st of May, gleefully, I'm free of you terrible landlord. She'd been there about 3 months, don't know what the problem was. She'd done a few things to the house. It looked quite nice. I do honestly think some people watched TikTok or something and thought, yay, pitchforks in the air, here we go, you evil. Then rescinded her notice because she realised she'd have to go and pay more to be somewhere else, whatever. Then gave her notice again, then rescinded it again. It's like, just chill. What are you doing and why are you doing it? So someone speak to her and find out what's really going on. So more look, shorter term tenancies are not funny, because it costs more to put them in these days, and the voids cost money. And if they haven't looked after it over a period of 8 months, and you're going to go through a deposit adjudication or whatever, again, it's painful. We do that when we have to. We follow the rules. We always win because we follow the rules. But still, it's not what you want to be spending your time on. And if our average length of tenancy in the PRS was 4.3 years last time I looked, ours was longer in the bigger house, in the sort of 2 and 3 bed houses, right? In the single lets. So we're having an average of a social lease almost anyway. So the void thing wasn't such a big deal, but the credit risk thing, and again, with a war going on, with a potential second wave cost of living crisis, you'll soon start hearing someone call it that, I'm sure, then you've got more credit risk than you had before. So it's what's changed relatively is important to understand. But what's the real term impact of that? If you had to put a percentage on it, how much worse is it than it was? Leave student HMO out of the way. Single digit percentage. That's the real world. It's the real world.
100%.
Yeah.
Do you still see the 10% yield northeast sort of 3-bedroom single buy to let as a solid investment strategy?
Well, I think you've got to be careful, because if you're going to sort of ex-colliery towns, I won't name too many in case I offend anybody, right? But you will know where they are, right? There's always been a problem with them. They've been sold in certain London auctions. Again, I won't mention them in case Andrew falls out. Sorry, did I say that out loud? But where they've sold them off to people who are yield chasers, who Mickey Mouse is on the tenancy and it's £450 a month and it's not, because they're not paying and they don't exist and the boiler's gone and blah, 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 right? As in actually physically gone. They're never a good investment. Let's be clear about that, right? You can't buy them at 25% yield because it's all pretend money anyway. But generally speaking, if you can carve that out in an area where there is economic activity, just simple as looking at, is the population growing over time, right? Where is the work? I love the places where they're putting a new station in somewhere, one of these parkway stations, or some of them sometimes around the country, reviving old stations, aren't we? I've invested in a few areas where that's happened, and it's been amazing, because suddenly the village or the town, the 10% most motivated people can much more easily get somewhere where the wages are higher. That money comes back to the village or town, and there's an arbitrage between the rents. They don't have to be in the city. They can go in and out of the city, but they can pay a bit more for a nicer place. It's not like they're paying a bit more because you're squeezing them. They suddenly have got the money for a nicer place and they want to invest in the nicer place. So if you, within those parameters, look, 10% is a good number and it will insulate you. Even if our cost base on a single is about 30%. That's high. Right. But it has to be high so I can do fun things like come on this podcast with you because I'm not doing the work. Right. So there's layers of not bureaucracy. We're pretty lean, but that's what's in place. There's a bit of out-of-town tax in there. Yeah. We're as efficient as we can be, but that's the real number, which is not dissimilar to the real number on operating a student block, actually, as it goes. About 30% is general going rate. And most people who are honest would tell you that's about right. Used to be about 25 pre-COVID, but maintenance costs are up so much and compliance costs are up. And that's what's taking that extra 20% increase, 500 basis point increase in that differential. But as long as you're not talking at 30 grand house at £3,000 a year, because the boiler still costs the same when it goes. So your gross to net will be deeply impaired. You know, as long as if you have a yardstick, if the rent's going to be at least 600 quid, which most of the stuff I go anywhere near around here, that is, unless it's a 1-bed flat, that's the collar these days. And even in the 1-bed flats, we're seeing 600 quid as a mid really here. So a cheap area 2-bed is going to be 700 these days, isn't it? I think you're okay at those sort of levels because it's £8,400 a year rent, right? So if you're picking them up all in at less than 84, and they're worth, they've got to be trading at that. But even if you're all in and you get a little discount that puts you back in at full price by the time you paid your extortionate 5% stamp duty, which I've mentioned at least 3 times now, because I'm so upset about it, the amount of it that I've paid over the years. It is a joke. I've paid more taxes, paid more stamp than Angela Rayner, I'll tell you that. Quite a lot more. Infinitely more. But all of those, they work okay. There's enough margin for the gross to net to work. And you're talking about an area where I don't see at the moment. I'd be more nervous if we were saying Northern Ireland, because it's absolutely, I shouldn't say blown up about Northern Ireland, that's a terrible thing to say, but it's gone gangbusters the last few years, hasn't it? And I always worry about getting on the gravy train too late, but they have benefited so significantly from Brexit, where we've lost out just economically. Northern Ireland, the beneficiary of that, because the whole fake border or whatever you want to go, it's just not there, is it? It's not there. So there's a big gain. But I wouldn't want to get too piled in around there. But those sort of 7-8% a year increases, they're never permanently sustainable. And Northern Ireland was very volatile around 2008 in terms of its pricing as well. It was much more up and down than the mainland. So, and it's a small place at the end of the day. There's not a huge number of households there. But when you've been seeing 3s and 4% and maybe the odd 5% in certain areas, feels pretty sustainable. But at the end of the day, like I said, what's the income been doing? Can the tenants afford it? Yeah. Is it taking, and again, something people don't look at, the ONS rental data goes back to 2005. If you go back to 2005 and look at the percentage of what tenants were spending of their income on rent, it was much higher. So they're still better off than they were in 2005. And inflation in the last decade, right, about 40%. Rents are still up about 38%. They still haven't even caught up with inflation over the 10 years. But because the last 4 years have been aggressive rises, that's what everyone's up in arms about, because they have this ideological idea that rent shouldn't go up. Well, tell me another industry where you massively increase the cost of delivery and you don't see an increase in the price. If it costs Sainsbury's twice as much to bring bloody apples over, they'll either not sell apples, sell crapper apples, right, or double the price of the apples. That's basic economics.
Yeah. The only fear is I think it's a irrational fear, is that there's further government involvement in the UK and then rent controls come in, which we've seen have an adverse effect on rents anyway and push rents up over the long term. But it's like you say, what you've just discussed is an open market. If the government get more involved,
it's good point and good challenge. And I think I've done a fair bit of extensive research about this. You might not be surprised to hear. There is a fairly left-wing Labour group called the Labour Housing Group, who published a paper on this. And they kind of stratified rent controls, because it's one big scary word, or two big scary words, I suppose, although rent's not that scary, but controls is. And that level 1 rent stabilisation, which is sort of intra-tenancy, so basic English, every year it can only go up by inflation. So Grainger already have a triple lock where they say rent only, and they use the word only, very good, right, goes up by the lower of 5%, wage inflation, CPI inflation. But what they mean is it always goes up every year by the lowest of those three, which most landlords don't do at the moment, right? So let's not forget that. So Grainger's tenants probably pay more in increases and they'll be paying more anyway, because Grainger are on top of absolutely maximising what they get out of stuff. They're a private company. They're a big one. They're a listed one. They've got lots and lots of very clever people that work there. They know what they're doing.
Mm-hmm.
So it's not a better outcome for the tenant, right? They would support that rent stabilisation. And the reason why they would support that is because little landlords would hate it because they wouldn't necessarily take the time to understand it. But of course, you get stuck. If you're a landlord, I know you will have seen loads of those over the last few years where that's happened. And ultimately, a landlord is charging £500 rent and now the market's £1,000. And they've never put it up for 10 years and suddenly they're stuck. They're completely stuck. Now, if you were then in a stabilisation period, imagine how much that devalues that property. I mean, goodness me, that is nearly a Rent Act 1979 controlled tenancy, right? Because the landlord hasn't done their job. If you're on top of it and the market finds the rent and then you increase it every year, I don't really think we've got too much to be scared about. But a percentage of the market would hate it, right? There's no two ways about it. Then you start getting into the more draconian controls, where the most draconian is they tell you where the rent is and it never goes up. Your New Yorks, your Berlins, that's where you are, tough guy, and it's where it was 50 years ago. And then, you know as well as I do, what all the research shows and what real life shows is black market appears, people are subletting, no one's doing any works, it's the Wild West, it's a terrible, terrible thing. And then in the middle of there somewhere is where it's free to move between tenancies, but there's a more draconian control such as no increase. When it's let at that level, that's what it's let at for the life of the tenancy, but the market can still set between tenancies. Now, 2 and 3 are pretty scary. And the danger, and I think rightly so, the worry for anybody would be, 1 is the thin end of the wedge. Now, this, not very long for this world administration that might even be gone by the time this podcast comes out, have many, many times said, don't support rent controls, they don't work. They put that Labour Housing Group paper away and said, that's not happening, we're not doing any rent controls. We should remember that really George Osborne drove a truck through social housing delivery in the UK because he stopped the guaranteed CPI +1 increase back in the old austerity days. One of the first things he did in 2015, right? What happened then? People stopped putting money into it. Why? Because institutions were happy with CPI +1 because they knew where they were, right? Now, remember this irony of, well, Scotland put the rent caps in, as you said. First year, up 12%. Second year, up 6%. I had loads of stuff in Scotland at the time, and I was laughing when I was reading these things, not because I was laughing at the plight of the tenants, because it was just such a joke, because they were saying, well, you need to be able to prove your cost base had gone up. And it's like, have you seen the inflation rate, mate? Don't be silly. Yeah. Every single person is going to prove that their cost base is up. And rents that year in Scotland were up 12%. The portfolio we'd bought in the west of Scotland, rents had hardly moved for 10 years, right? And now they're about 60% up from when we bought it. Not because we've asset managed it so well, but because of what they did to control the rent, shafted everybody, including the taxpayer who's paying the extra housing benefit from 2024. But of course, it's all right now because they've frozen that and that'll sort it out, which it absolutely won't. So there are no good examples of rent control working. Rent control, to be as charitable as you can be, is okay when it's been in place for a long time for the people who exist in the market today. But it's a bit like right to buy. If you were in a council house in 1979 and you suddenly got the right to buy, massive discount, and you could do it in 1980, like 140,000 people did, or whatever it was in the first year it was released, amazing. What did that mean for those of us who weren't in a council house in 1980 because we weren't born or we were only little like me? Ultimately, it meant that there wasn't a replacement of that. That was a one-shot deal, right? And a generation of people got that, including Angela Rayner, was a ghost actually, and benefited from that, and everybody else lost out because of that. Now, some people would say, well, not everybody needed it, which they didn't. They were in their own houses and stuff like that. But today's renters, how much have they benefited from the right to buy? They've got shafted because they haven't replaced. And now replacement is a fake thing, where last year we sold 7,500 units under right to buy in the UK, most of them 3 and 4 bedroom houses. We replaced 3,750 of them, so about half of them, and we replaced with 1 and 2 bedroom flats. So we didn't replace them. And that stock, dwindling stock, especially of 3 beds, which is why 3 beds are such a good, robust, long-term, low volatility asset class. As long as you can find a 3 bed with a 10% yield on a single let, so someone in a working place with an active economy, jackpot. Yeah, jackpot.
No brainer. It's actually pretty much what I buy. That's all
Fantastic.
I buy. Yeah.
And that's the beauty, isn't it? In many ways of property, it doesn't have to be rocket science, right? you do need repeatability. You do need discipline. You do need all those things. You need to, you're not buying them at market price. I assume you're getting deals, right? So you have to work out how you get your deals and stuff like that. So that's where the alpha comes in. But the beta of the underlying asset is fantastic.
Yeah.
Fantastic.
100%. Adam, it's been absolutely fascinating. I've got one last question. I just want to know, is there an end goal for you? And if there is, sort of what is it?
Well, I don't have as many units. That I have been up at a higher number of units than I am today. So my recent activity has been more selling than buying, right? And I just explained that why that is, because a lot of stuff that we had the luxury of anything below 200 to 250 grand probably that came across our desk that was a deal back in the days of 3% interest rates, we could hold on to it. We've got a lot of those. I fairly famously broke a lot of my mortgages in 2022, fixed them out to 2027, 5-year fixes, paid the ERCs, fixed at the old rates. Well done me, really clever. Didn't predict Liz Truss, right, but predicted that rates would go up and benefited from that, right? But then it's 2026 now and it's 2027 soon. So a lot of those don't work when we go to 6.25 interest, if that's where we're heading when I have to refinance them. So I've had to sell them. I've had to look at selling some of them because ultimately I'm not going to hold on to them to break even for a bit of capital growth. I've got equity in there. I'll redeploy the equity. My best activity is buying because that's when I add the most value because I'm good at getting deals, right? And I've made myself to be very good at getting deals over the years. So do as much buying as possible. But in today's world, with a 6% interest rate, to do more buying, you've also got to do more selling. Yep. So our effort has gone up and our model has pivoted slightly around. There's quite a lot of stuff we need to sell off strategically, right? I'm not necessarily saying we're turning into flippers and things like that because we're not. It's not our model as a rule, although we do the right thing for the right property. But generally, we're still trying to buy to hold, but that hold period has come down ultimately. So my goal in the first place was to build a machine that worked, right? And then I've got obsessed with it. I've got fascinated with it. When the machine works, you turn the handle. When you got to fix the machine, that's where it gets really exciting. And geeks like me have got the goggles on and under the thing, like tinkering with something else or whatever. So what I've always said, I'll buy property in the UK. If, we said earlier on, if Polanski comes in and wants to buy the whole portfolio at market value, he can have it tomorrow. 100%. I will shake his hand and say, well done. What will I do with the proceeds? I'll buy rundown properties, do them up. I'll buy properties with problems. I'll start again. Right? That'll annoy him. Unless I'm legally legislated against doing that, in which case I'll go to Ireland and do it or whatever. You know what I mean? Probably. So I will always buy while it's worth buying in the UK property market. And while it's the cheapest it's been for 23 years in real terms, by God, is it worth buying? Because there's going to be a year before the end of this decade, right, where prices go up 8.6% and everyone goes, oh, I didn't see that coming. Well, I did, right? I did, and it's going to happen. And that year is going to be one hell of a year because with leverage, that is a really, really nice return. Yeah. And that'll also be a great market to sell in by the time you're getting around to that. So I love the challenge of it. I'd be bored if I wasn't doing things like that. As I say, I have the luxury and I have some brilliant people who do things day to day in offices, out on the road, all the rest of that, who are enabling me to pontificate, quite frankly, Dave, in my head about what's going on in them and put all that effort that I do put into thinking, can I see around the corner economically? So I will be cracking on doing that while I'm still enjoying it and while there's still breath in my body and until one of these left-wing lunatics tries to stop me. And let's see what they can do.
Yeah. I'd back you in that fight, mate. I think,
I've looked at things like, is it worthwhile starting a REIT, a real estate investment trust? The benefit of that being no corporation tax in the UK. The downside of that being it's costly to run. I would certainly lose an element of control. Yeah, I don't really want to be the CEO of the REIT. I want to be a shareholder in the REIT. It's a possibility, and I've enjoyed the conversations that I've had with much, much bigger vehicles, people who've got £1 billion worth of property and stuff like that I've been talking to over the last 12 months and their sort of view on all of that. So maybe drag a load of investors with me into a REIT style situation so everybody can stop worrying about the day-to-day management and make sure something works, because residential REITs are few and far between. There's a bit of AI work that needs to be done to get everything singing, and there's the maintenance side of things that's a potential sticking point with that, or maybe there's a social REIT in there somewhere, which I wouldn't mind being involved in case anyone's listening and fancies sending me a message about that. I'm very happy to have a conversation about it. But yeah, pressing on, not because I never bought into the get X per month, because I don't do it for the money. And it's easy to say that when you make a load of money every month. I know that, right? I'm not being a ponce about it. That's what it is. But I'm enjoying the journey, and I don't want the journey to stop just yet. And I'd like it to stop on my terms when it does, rather than hopefully something not happening to me. But ultimately, I've got people that I've taught how to do it, that I work with day to day, who could carry things on anyway. Even in the worst case, Polanski assassinates me in the street or whatever. When he hears this.
Mate, I can tell you're still so passionate about it, and it's brilliant. Even after everything that you've achieved, is to still have that passion and drive, and I can see the glint in your eye when you're talking about it. So hopefully that never leaves you. And the conversation we've just had is just so valuable to my listeners, and I really appreciate your time. If people want to continue following your journey, which I'm sure a lot of them do already, what's the best place to
So I've got a YouTube, Proponomics with Adam Lawrence, property and economics together. So if you can't sleep at night, I can guarantee you like an hour and a quarter of my dulcet tones.
It is a good listen, to be fair. It is a good listen,
I get into it in I try to seek the truth. I don't have an agenda when I publish that. The reason why I do it is because I want to think through the events of that week, the events of the month, expand out. How are things changing? And absolutely, you've got to keep an eye on him, right?
Yeah, 100%.
He's lively. Whatever you think of him, he's lively. So, and he's having a big impact on things in the world. So you got to be on top of all of that, in my opinion. I've got a lot of tens of millions of pounds worth of debt, right? So my job to me and my kids, my family, is to make sure that I'm a good custodian of that debt. So the YouTube, absolutely, Proponomics. I love a few extra followers. Always love a bit of that. And my LinkedIn, I publish at least once a day on LinkedIn. Research pieces, they do get a bit heavy. I warn people in advance. Ever since AI introduced the deep research concept, you can't do that to a nerd like me, because it's like, well, I've got 1,000 questions I wanted to answer, so let's have one every day for 3 years. Right. And so I love doing that. So my LinkedIn is Adam Lawrence. Anyone wants to follow me on there. I try to reply to messages, but don't send me like, how do I sort this problem out? Because I get 20 messages a day anyway, so I just don't have time for them. But I love connecting with people. I love going out and talking at networking events when I can, where I can, and just trying to spread a bit of the knowledge. So that's the best way. We also do run property business workshop once a quarter, usually in London. Last one we did in Manchester. Great people in the room. It's impossible to sell the tickets because it's dead unsexy, right? Our next day is on due diligence. Who would be stupid enough to try and sell a ticket to a workshop on due diligence? But that's exactly what we're trying to do. Yeah. So that's in July. And it's a great room of people. And we teach the stuff that, frankly, I see people not being taught by the smoke sellers. And that's why we do what we do. And then we have our boardroom club, which keeps me out of mischief once a month as well, myself and Rod. Love doing that. I've been doing that 6 years now, and I've had the privilege of working with about 50 brilliant businesses, all of whom, and that's one of the things I love about property, who do it a different way. Yeah. And it's not a right or wrong. Exactly. It's not a right or wrong thing. And some who, I mean, like I said, I didn't start in property till I was, and hopefully this is useful to some people listening who are much younger than my advanced years. I didn't start till I was 32, right? So I didn't know no properties until that point, right? So no investment properties anyway. So, it
shows what you could be doing.
Look at what some of the 20-somethings who've been on your podcast put me to absolute shame. They made me think, incredible. Why was I was just cocking around, I think, when I was in my 20s, but
they're so focused.
But let the listeners be in no doubt, this is the best asset class in the world
100%.
For all of the reasons that we've said today. It always was. Certainly post-crash, and certainly, pre-crash, if you bought 500 no money down, well done. I'm gutted I wasn't in them. I'm old enough to be in the market back then. I just wasn't there. And it will remain so, because it has so much use and such limited risk. As long as you manage those risks, it's a beautiful thing. Yeah. And time does the work, like you said earlier.
Great way to end. Thank you, mate. Really appreciate your time, Adam. Thank you so much. If you have enjoyed today's show, which I'm sure you have, please do like, share and subscribe. It does really help. Until next time, take care.